Check, check. Fine. Now, my dear students, what are we starting with? We are starting with your WSC calculations. Okay, weighted average cost of capital. Okay. Now see, as we have discussed, whenever we are dealing with your WSCC, what's the first thing which you have to understand? We need to check that how are we going to raise the funds. Okay. Whether there is one source or there is going to be multiple sources on the basis of which we are going to raise the funds, beta. Multiple sources, and we are required to calculate now what is the overall cost of capital. Okay, so multiple sources and overall cost of capital, that needs to be taken into consideration. Okay, see here we have to check whether there is book value weights, market value weights, or marginal value weights. Okay, but before that, first let us read your illustration number 16. Cost of equity of a company is 10.41% and cost of retained earning is 10%. Here in this particular case, is the KE and KR different? Come on here. So in market value weights, are we going to consider KE and KR both the things separately? Come on, yes or no? Yes. Because your KE and KR is different. If your KE and KR would have been the same, then in market value weights, we would have only considered market value of equity. But here your KE and KR both are what? Different. So that is why we have to calculate what should be your WSCC. Okay. There are 50,000 equity share of rupees 10 each and the retained earnings is 15 lakhs. Market value per share is 50 rupees. We are required to calculate WSCC using market value weights. Now please tell me, to calculate your WSCC using your market value weights, we will have to take into consideration your equity also and reserves and surplus also. Both these things are going to be there, equity as well as your reserves and surplus. Can you please give me what is your market value of equity? Can you just check market price of the share is what? 50. And what are the number of equity shares? There are 50,000 equity shares. So what will I do? I will take 50,000 shares and multiply that by 50. Will that give you market value of equity? Come on, yes or no? Yes, sir. Can you please give me what's the market value of equity, beta? 25 lakhs. And they have told you that the retained earnings is for 15 lakhs. Now, my dear students, if there would only have been KE and KR would have been the same, then I would have written only equity 25 lakhs and I would have done it accordingly. But in this question, my KE and KR, is it same or it is different, beta? So that is why I have to write down your equity also and I have to write down your reserves and surplus also. So this 25 lakh rupees, which is market value of equity, I have to divide some part in equity and some part in reserves and surplus. So what should be the proportion in which we have to make this division? So that proportion has to be your book value weights. That proportion has to be what, beta? Book value weights. So do you have book value of equity share capital? Yes. 50,000 equity share of rupees 10 each. So can I say that is 5 lakhs? And reserves and surplus has a book value of what? 15 lakhs. So can I say I have to now divide this in the ratio of what? 1:3. So now this 25 lakhs, which is the total market value of equity, I need to divide this in the ratio of what? 1:3. 1:3, sorry. So 1/4 and 3/4. So please take 25 lakhs, divide that by 4. Can I say 6,25,000? That will be your market value of equity. And from 25 lakhs, if I subtract 6,25,000, what's my reserves and surplus, which is coming as 18,75,000. And do I have the KE percentage given to you? Yes, sir. How much is that? 10.41. And what's my KR percentage which is given to you, beta? That is given to you as 10%. Now, what is this weights which is going to come? So can I say my weights will now be 6,25,000, divide that by 25 lakhs. What is this coming as? 0.25. And what is this which going to be coming as? 0.75. So you take 0.25, multiply that by 10.41. that is going to be your 2.6025%, and take 0.75, multiply that by 10, that will be 7.5%. What is going to be the total of this? 10.10. This is nothing but your KO. So your KO should be nothing but 10.1%. Are you guys trying to understand this? Okay. But for that, what did you understand first? That if the KE and KR would have been the same, then entire 25 lakh rupees was nothing but market value of equity only. And we would have considered that KE only as your KO. But unfortunately, what is happening? That KE and KR both are same, or KE and KR are different, beta. Different. So it is important that what are we going to do? We will have to definitely do the bifurcation of this 25 lakhs on the basis of book values of equity, share capital and reserves and surplus. And based on that, we calculate your KO, and that KO turns out to be your 10.10%. Convinced? Everyone's okay with this? Okay. Then question number 17. We are required to calculate the WACC using book value weights and using market value weights. So guys, here in this same question, we are going to use book value, market value both. And whatever the data which is given to you, that is the capital structure of the company. So all these values which are given to you, that is your book values, or these are your market values, book values. Because this is from the capital structure of the company. Capital structure of the company means what? Whatever is there in your book value, we are taking that into consideration. Okay. And now the market prices are given to you for each of the securities, which are debenture 105, preference share 110, and equity shares 24. Now, what is the additional information which is given to you? Rupees 100 per debenture, redeemable at par, 10% coupon rate, 4% flotation cost, and 10 years maturity. 100 preference shares, redeemable at par, 5% coupon rate, 2% flotation cost, and 10-year maturity. And equity share is 4 flotation cost, market price is 24 per share. Then next year expected dividend is 1, growth rate is 5. The firm has the practicing of paying all the earnings in the form of dividends. Corporate tax is 30%. Use YTM method to calculate the KD and KP. So to calculate KD and KP, which method we are going to use? Beta, YTM. So when there is YTM approach, then in that particular case, don't you think we do that by the way of that table, trial and error method? And based on that, we will get the percentages on the base of which we'll be getting your KD and your KP. So can I use the formula for KD here? No. What do I have to use? Table, and use interpolation and use trial and error method for the purpose of getting the answer. Okay. So even they have done it on the same basis, and they have taken the range and they have calculated. Can you just check? See, they have used the word IRR. So based on IRR, we calculate your K and KP, and then finally we'll be getting the final answer. But always remember, whether there is book value weights or market value weights, just check. Do you have this after tax cost of capital same? Then the answer is yes. So whether there is book value weights or whether there is market value weights, the cost which we are going to calculate, that is going to be calculated in the same way only. But the only thing is the difference will be in the weights part. So your KO is going to be different, but the KD, KP and KE which we are going to calculate, will that be constant whether there is book value weights or whether there is any market value weights? Your KD, KE and KP is always going to be the same. This question, I want you all to solve this along with me. Go to your notebooks and we'll do this together. Okay. Let's practice this question. So now we are calculating question number 17. Okay. Okay. So let's do this together. Okay. So now this is which question? Beta, question number 17. Illustration 17, which we are solving it. Okay. Now, see, first what you should do is you should prepare a table. Calculation of WACC using book value weights. Hello. And here we'll be writing down sources, amount, weights, COC, WACC. Okay. Can you please tell me how many sources are there, beta? 3. Debentures, preference shares and equity shares. Okay. And similarly, we will prepare one more table, which is calculation of WACC using what as weights, beta? Using market value weights. Same process will apply sources, amount, then there will be weights. Come on here. There will be cost of capital, there will be WACC. Okay. So sources will also have what? Debt, preference shares and equity shares. Okay. Now, what is the amount column? Can I say if it is book value weights? If it is book value weights, can I say I should take balance sheet values? So it is going to be the same only, 5 lakh, 5 lakh and 10 lakhs. So this will be 5 lakh, this will be 5 lakh and this will be what? 10 lakhs. So what's the total? 20 lakhs. Can I get the weights, guys? What is my first weight? 0.25. This will also be 0.25. This will be 0.5. Now, in your debt market price, have they given to you market price, guys? What is the market price they have told you? What is the market price they have told you? 105. So now I have to check what are my number of debentures. See, this is 5 lakhs and the face value is 100 rupees. What are the number of debentures? 5,000 is the number of debentures. Okay. And these 5,000 debentures, now I need to multiply it with what rate, beta? Market price, which is nothing but what? 105. So give me what is this going to be? 5,000 multiplied by 105. Tell me what is this? 5 lakh 25. Come on here. 5 lakh 25. What about preference shares? For preference shares, this is 5,000, 5 lakh divided by 100 each. Can I say this will be nothing but 5,000 preference shares? I need to multiply it with what price, beta? 110. So this will now become what? 5 lakh 50,000. And the last case, just check what are the number of equity shares. 10 lakh divided by 10. How much? 1 lakh shares. And I will multiply that with the market price. What is the market price, beta? 24. So what is this going to be? 24 lakhs. Hello. Now give me the total of this. Yeah, how much is it? 34 lakh 75,000. Everyone's getting this as 34 lakh 75? Okay. Now give me weight size. Can I say the first weight will be 5 lakh 25 divided by 34 lakh 75,000? What is this? 0.15. Then point. So see, this is 5 lakh 25 now. You divide that by 34 lakh 75. This is 0.151. I am writing it down. And then 5 lakh 50. If I divide that by 34 lakh 75,000, this is 0.158. So I'll write down this as 0.16. Let us take only up to 2 decimals. 0.15, 0.16. And what about the last case, 24 lakh? If I divide that by 34 lakh 75,000, this is 0.69. The total has to be 1. Just make sure. Okay. So they have taken up to 3 decimals. I am just taking up to 2 decimals. This answer is going to be the same only. Okay. Chalo. Now let's talk about KD. Are you all okay with this much? Okay. Weights is done. Now let's talk about KD. So KD, how are we going to calculate, beta? By using the formula or by using YTM method? YTM method. So for YTM, you all will now prepare working note number 1, KD using YTM. Okay. We are calculating KD using which method, beta? YTM. So when we are calculating KD using YTM method, what are we doing? There will be years. What is the life? Now let us read all these things. What is given to you in the question? That rupees 100 per debenture redeemable at par 10% coupon rate, flotation cost is 4%. So first of all, here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And now I'll be having interest also and I'll be having redemption value also. Right? So what is the interest? Interest is always on the face value. So coupon rate is 10%, face value is 100. So interest will be 10 into 1 minus what's the tax rate? 30%. Come on here. So that is going to be 7. Come on. So this will be 7 for the period of 10 years. And then at the end of the 10th year, don't you think there's going to be redemption also? And is the redemption happening at par, premium or discount? Par. So can I say you will be getting 100? So that will be 107. Are you guys getting this? So this will be 107. And now let us discount it at how much percentage? Now see here, what is going to be your net proceeds? Just check. Here there is 4% of flotation cost. Everyone take on your calci 105 because 105 na. Just check what's the market price beta? 105. Now market price is 105 and flotation cost is how much percent? 4%. So can you please give me what's your net proceeds? 100.8. So your target is to get 100.8. Your target is to get what? 100.8. This should be your present value. Your target is to get 100.8. Now to get this 100.8, we have to discount it. Now what should be the range of the discounting factor? So now we will take the discounting factor. Let us try it at 5%. Let us try it at 5%. Trial and error basis. You can also do it at 10%. You can also do it at 8%. You can also do it at 2%, 3%. We are trying it at what percentage? 5%. Okay. I'll give you one very shortcut method. Okay, how to determine the range. So I'll tell you. Though they have not told you using the formula, but I want you to use the formula once. Okay. Use the formula and give me the KD. KD will be interest into 1 minus tax, that is 7. What is your RV? 100. What's your NP? 100.8. What's your life? 10 years. Okay. And then you take 100 plus 100.8 divided by 2. I know they have not asked you, but just calculate like this. So this will be now what? 100 minus 100.8 divided by 10 plus 7. So this will be 6.92 and 100 plus 100.8 divided by 2. That gives you 100.4. So now you take 6.92, divide that by 100.4 into 100. You should all get this as 6.89%. So did you realize one thing? That if this is 6.89%, it means that your IRR range will be somewhere between 5 to 10%. Hey, hello, did you realize that it should be somewhere between 5 to 10%? Okay, so if you want to know what should be the starting point, so you can just make this in rough work. Barabar. You just make this in what? Rough work. So you come to know that this is 6.89%. Then you will realize, oh, this is 6.89%, which is falling between dash and dash, 5 and 7. So can I say now I can take a range of 5 and 7 and do it accordingly? Come on, yes or no? Yes, sir. Did you realize this? Okay. But let us not take 5 and 7. Let us take 5 and 8. Because sometimes you do rounding off now, then at 7%, I think things will not be possible. So let us take 5% and 8%. But definitely it's not 10 and 15. Are you understanding? So by using the formula, at least you will get a percentage. On that basis, you get a range. So now let us start at 5% and let us check what's the PV which you are getting. And then try it at 8% and just check what's the PV which you are getting. Okay. So at 5%, let us calculate this. 1 divided by 1.05. Now see, for 10 years now, this 7 rupees is same. So can I use present value annuity factor? Okay, so I'm just giving you a shortcut method. I will explain you this in investment decision, but the 7 rupees is constant, right? For every year. So instead of taking each and every year PV factor, can I combine all the PV factors and get this, which is called as actually your PVAF? present value annuity factor. So that will make your calculation much more faster. So I will tell you what you should do. Take your calci, take 1 divided by 1.05. Okay. Now press is equal to. Can I say you all have got 0.95238? Come on here. This is the PV factor for 1 year. Press it 10 times. Matlab this is for the first year. Press for the second year is equal to. Press is equal to third, fourth, fifth, sixth, seventh, eighth, ninth, 10th. Are you all getting 0.6139? Okay. Now press GT. I hope you all have GT. Press GT on your calci. You should all get 7.72173. Now you multiplied that by 7. You all should be getting 54. So can I say present value of interest is 54.05. Now calculate what is this 100 rupees which you are receiving at the end of the 10th year. Because I have already considered interest of 7 rupees. So now what is remaining is 100 rupees which you are getting at the end of the 10th year. So now whatever you got now 54.05, put that in M plus. Put that in M plus. Now press 1 divided by 1.05 and press 10 times is equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You should all be getting 0.6139. Then you multiply that by 100 rupees. Okay. And press M plus again. So this 100 rupees present value is nothing but what? 61.39. Now press MRC. You will come to know, oh, this is coming as what? 115.44. This is coming as 115.44. Is this 115.44 greater than 100.8? So at 5%, definitely it's not the discounting factor. Now let's check at what percentage? 8%. Again, 1 divided by 1.08, press 10 times is equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And then press GT. You will be getting 6.71 something something. Multiply that by 7 and put that in M plus. So you should all be getting this as 46.97. Then once again take 1 divided by 1.08. Press 10 times is equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You should all be getting this as 0.46319, which you multiply again by 100 and put that in M plus. That is 46.32. So what's the total which you are getting? 93.29. Now is this less than 100.8? Hello? So now have I got the range? At 5%, what is this coming? 115.44. At 8%, what is this coming? 93.29. Now have I got a range? Because I want to get 100.8. Is 100.8 falling between 5 and 8%? Come on, yes or no? Yes, sir. So it is more than 5, but it is less than 8. Now please tell me what's the difference between 5 and 8? 3% is the difference. Now at 3% difference, how much have I discounted? So that is 115.44 minus 93.29. Can I say I have total discounted 22.15? But I don't want to discount 22.15. From 115.44, I just have to reach how much? 100.8. So now in this particular case, 115.44, if I subtract 100.8, what am I going to get? 14.64. So now can you please tell me 14.64 into 3 divide by 22.15. How much is this beta? 1.98%. So if I take 5 plus 1.98%, what am I going to get? 6.98%. And if you guys just check, the answer for this is 6.89%. Our answer is 6.98%. Have you guys got this? So if you take 5 and 7 exactly, you'll be getting 6.89. Okay. But if you do it like this, you'll be getting 6.98%. Absolutely perfect. Perfect. Okay. Everyone got this? Same approach, can I say you can also do it for KP? Right? For KP, you can also calculate your KP formula. And based on that, you will be able to get what is going to be that percentage. And once you get that percentage, the range will be very much applicable for you. Okay. That you can practice on your own. I'm not doing it here now. Okay. But on that basis, you will calculate, you will be getting the KP, and the KP is coming as 4.08. So ultimately, this will now be debt 6.98, 6.98. Can I write down debt? Both the cases same cost. Solo yaar. Then KP 4.08, 4.08. Okay, this is coming as 4.08. And then we are just required to calculate your KE. Now for your KE, what have they told you? That for your KE part, they have told you that there is a flotation cost of P4, market price is 24, and next year dividend is 1. How will you calculate KE, guys? D1 upon net proceeds into 100 plus G. What's your D1, guys? What's your D1, everyone? So this will be 1. What's your net proceeds? Can I say it will be 20? From 24, I'll subtract 4 rupees flotation cost, it will become 20. Multiplied by 100, and what's your growth rate? 5%. What is this answer? It should be coming as 10%. So that's your key, 10%. And then you all know how to calculate your KO. You all have to just multiply this, get this WSCC, you will be getting your KO part. Superb. Everyone's okay with this? Sure, confident? Perfect, great, amazing. So with this now, your question number 17 also gets completed. Okay. Now let's do this question number 18. Now this is slightly difficult, but yes, important from the examination perspective. So we'll be doing this question number 18. Okay. So I have revised entirely book value weights, market value weights. Now this is one of the question on marginal value weights. This is something which we're going to discuss. Okay, so get ready for this question. Very nice question. Okay. Now, what is going to happen in your question number 18? Okay, pay attention to this. Very, very, very important. Okay. ABC has the following structure which is considered to be optimum. Now, whenever you see the word optimum, now for this particular question, you have to use a very different approach. Okay, now what is this optimum word? Suppose a company tells you that we are having debt equity, okay, and 60% of debt and 40% of equity. This is the optimum structure. So what is the optimum structure, guys? Debt should be how much? 0.6, and equity should be how much? 0.4. Now, company has already raised 5 lakh rupees. Can you please tell me how this 5 lakh rupees is being raised? 60% debt, it means 3 lakhs. And 20% equity, 40% equity, that is nothing but 2 lakhs. That's how they have raised the capital. Now, company wants to raise another capital. Suppose company wants to raise now more 1 lakh rupees. But in what weights will they use 1 lakh rupees? How will they raise 1 lakh rupees? So when they have given the word optimum, can I put it like this? That this 1 lakh rupees is actually raised by taking 60% debt and 40% equity only. Because in the question, do you have optimum capital structure given to you? Come on, yes or no? So that is why, how much are we going to raise by the way of debt? 60. How much are we going to raise by the way of equity? 40. So this is something which is decided. So whenever the company has specified optimum capital structure, so even one extra rupee which you have to raise, how will you raise it better? Can I say by optimum capital structure only? Come on, yes or no? Yes, sir. Acha. If I tell you that, if suppose you are raising 40,000 by the way of, if you are raising 40,000 by the way of equity, can I calculate what can be your total amount which can be raised by the way of your total capital employed? Come on, yes or no? Yes, sir. So sometimes now I can give you 40,000 rupees just by the way of equity. From that 40,000 rupees by the way of equity, can I calculate what can be the total amount which is supposed to be raised? Come on, yes or no? Yes, I can calculate on that basis also. So my dear students, always understand like this, that we have to take into consideration what is the optimum capital structure. That is very, 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 very important. Okay. See, read the question. ABC has the following structure, in which there is 14% debt, 11% preference shares, equity shares. Now this, they have told you optimum capital structure. Can you give me what is the percentage of debt now? If I take 30,000, if I divide that by 2 lakhs, can I say my debt will be 0.15? If I take 10,000 and if I divide that by 2 lakhs, can I say this is nothing but 0.05? If I take 1,60,000, if I divide that by 2 lakhs, so this is nothing but what? 0.8. So can I say the total is going to be 1? Okay. So the total is going to be 1. Are you all comfortable with this much part? So this is nothing but called as your optimum capital structure. Is this your optimum weights which is there? Come on here. Is this your optimum weights? Come on, yes or no? Yes. Which is 0.15, which is 0.05 and 0.8. So any single extra rupee which you have to raise on the basis of this weights only. That is the meaning of optimum capital structure. Are you guys understanding this? Okay. The company's share price is bought 23.6. Next year, the dividend per share will be 50% of 2022's EPS. And following is the uniform trend of EPS preceding for the last 10 years. Just check for the last 10 years from 2013 to 2022, we have the EPS which is given to you. Can you just check, is the EPS constant or the EPS is growing? And can I say the EPS is growing at a constant rate of what? 10%. So my growth rate is 10%. The company issued new debentures. Now the company is issuing new debentures carrying 16% rate and the current market price is 96. Preference shares is 9.2 with annual dividend of 1.1 were also issued and the company is in 50% tax bracket. They are required to calculate cost of new debt, cost of new preference shares and cost of new equity shares, assuming new equities from retained earnings. So now, my dear students, we are required to calculate these 3 types of cost. Okay, first of all, how will you calculate your cost of debt? How will you calculate your cost of debt? Can I say your cost of debt will be calculated by taking interest into 1 minus tax upon net proceeds into 100? Solo yaar. Okay. Now please tell me, what is the face value? See, market price is 96. So obviously the face value will be what? 100. Acha, by the way, we are required to calculate cost of old debt or cost of new debt, beta? Cost of old debt or cost of new debt? New debt. So what is the face value? 100. Rate of interest is what? 16%. So can I say 16 rupees is your interest? What's your tax rate, guys? Your tax rate is nothing but 50%. And what's your net proceeds? Your net proceeds is nothing but 96. So what is going to be your final answer? 8 divided by 96 into 100. What is this answer going to be? 8.33%. What about the second part? KB. And KB, can I say that will be nothing but preference dividend upon what? Net proceeds into 100. What's your preference dividend? Your preference dividend, my dear students, what's your annual dividend? 1.1. What's your market price? 9.2. So now how are we going to calculate? 1.1 upon 9.2 into 100. Can you give me the answer? What is this going to be? 11.96%. And then third part, they have told you to calculate your cost of equity. But they have told you that this is nothing from your retained earnings. So from your retained earnings means normal calculation only. D1 upon, will I write down here NP or P0? P0, because this is retained earnings into 100 plus your growth rate. Can you please tell me now what's your D1? Guys, for your equity shares, they have told you that the market price is what? 23.6. So I'll divide that by 23.6. What's my growth rate? 10%. And what's your D1? So can I say your last dividend was, what was your last dividend, beta? They have told you your last dividend was 2.36. Right? They have given you last 10 years earning per share. So last earning per share is 2.36. How much percent are you giving by the way of dividend? How much dividend? 50%. So can I say 50% of 2.36 will be what? 1.18. Come on here. They have told you now that we are required to, see, read the question. The next year dividend is 50% of 2022's EPS. So that is nothing but 1.18. Now will I add any growth rate to this? What do you think? The answer is no. Why? Because this itself is your next year's dividend. So this has to be 1.18. So what is going to be the final answer? 1.18 divide that by 23.6 into 100 plus 10. So can I say the answer is going to be 15%? So what's your answer? 8.33, 11.96, 15. Just check. 8.33, your 11.96, which is coming as they have rounded off to 12, and this is 15%. Have you all understood this? Okay, sure. First part is done. Second, calculate marginal cost of capital when no new shares are issued. Now, we don't have any weights, but we are required to calculate your marginal cost of capital, that is nothing but Q. How will we calculate Q, guys? So to calculate Q, we'll be having debt, we'll be having preferences, and we'll be having retained earnings, which is reserves and surplus. Right? We can use this. But now in this particular case, what should be your weights? Tell me, what should be your weights? What should I take my weights as? Can I say it should be optimum? The one which I have just now calculated here in the question. This is my optimum weights. I told you now when the optimum word is given to you, so any new single rupee which is supposed to be raised, how will we raise it, beta? Can I say on the basis of optimum? Solo here. So now do I have the optimum weights? Come on, yes or no? Yes. What is that? 0.15, 0.05 and 0.8. Come on here. And now on the basis of this, what's my cost? My cost, as I told you, for retained earning is 15%. This is what? 8.33 and this is 11.96. Will I be getting my final answer? That is Q. Come on, yes or no? Yes, sir. Any doubts, beta? Okay. Next, third part. What is the third part of the question? Determine the amount that can be spent before new ordinary shares are issued. What is ordinary share? Equity shares. So before we issue equity shares, what is the new amount I can raise? That is something which is asked in the question. For that, do you have any reserves and surplus in the question? Now see, you have reserves and surplus. How do I have reserves and surplus? Just check. What was my EPS, beta? 2.36. How much dividend am I paying? 50%. So that is nothing but 1.18. What are my number of equity shares? What are my number of equity shares? Just check in the question. There are 10,000. So can I say at least I can use reserves and surplus of 11,800 for the purpose. 50% I'm giving by the way of dividend. So 50% I'm retaining. So can I use 11,800 for the purpose of expansion and growth? Come on, yes or no? Yes, sir. Now just check. This is the retained earnings. I can use it for the purpose of expansion. So we have debt, we have preferences, we have reserves and surplus. Do I have the weights available? Yes, sir. What are my weights? 0.15, 0.05 and 0.8. Correct? Now, do I have reserves and surplus amount available? Yes. How much is that? 11,800. Can I get the total amount? Come on, yes or no? Yes. So you take 11,800 and divide that by 0.8. That is 14,750. So can I say 14,750 I can raise without even issuing one single rupee of equity share? And out of this 14,750, can I say I'll be having reserves and surplus? Yes sir, no sir? Yes sir. What will be that amount? 11,800. Will I be having any preference share capital? Yes or no, sir? Yes, sir. That will be 0.05. That is 5% of this. And then I'll be having my debentures, which is 15% of it. Got it, everyone? Okay. And then after that, what's the last part? They have told you, compute the marginal cost of capital when the funds exceeds the amount calculated in C, assuming new shares are rupees 20. So now if suppose I want to raise any single rupee, which is if I want to raise any new funds which is more than 14,750, then can I say compulsory I have to issue equity shares? Come on, yes or no? Yes sir. I have to issue equity shares. I have to issue equity shares. Because now 14,750 I can use reserves and surplus. But now if I want to raise 20,000 rupees, is there any reserves and surplus which is there with me? No. Can I say I have to issue fresh issue of equity shares? Come on, yes or no? Yes, sir. So for that, what should be my new KE? D1 upon net proceeds into 100 plus G. Can you give me D1, guys? What's your D1? What's your D1? 1.18. What's my net proceeds now? 20 into 100 plus the growth rate is 10%. Can you give me this answer? 1.18 divided by 20 into 100 plus 10. 15.9%. Now, what is going to be the Q? I will have equity. I will have first debt, preference shares, equity. Do I have the weights available? Come on, yes or no? Yes, sir. 0.15, 0.05 and 0.8. And I have now KE as 15%. What was my KD? 8.33% if I'm not wrong. They had given now KD and 11.96. Now I will get my new KO. So if you want to raise anything above 14,000, then this is how we can raise it. Can you give me the answer now? 0.15 into 8.33, 0.05 into 11.96 and 0.8 into 15. The total is 13.85%. What? 15.9. Okay, sorry. 15.9. So this will become 0.15 into 8.33, 0.05 into 11.96, right? And then 0.8 into 15.19. How much is this coming? 13.99, which is approximately 14%. Is this coming as 14%? Just check. Because they have taken 12 now. We have taken 11.96. Rest everything is same. 15.9, 14.57. Understood this? Okay. That's it. So with this now all my illustrations are over. What are we going to do next? We'll be starting now with the practical problems. Okay. We have in all some 7 practical problems. We'll be doing that. We'll take a lunch break now. Okay. After that, we will continue with this. Okay. Chalo. I'll see you on 2:30, 2:35. We'll continue this further. Take a break. Check. Okay. So let's continue this further. Let's do this. Now we are doing practical problems. Okay. Let's start one by one. First practical problem. See what is given to you. Online students, you guys are there or you all have slept? Let me just check. After having so much of rice, I'm very sure. Where are my online students? 1 second. Yes. Online students, you guys are there. Come on here. The last chat was at 11:47. Where are you? Hello. Nitaji, Gautam. I think I have to take more 50 rupees from them now. Okay. Perfect. Shall we start? You guys can see me properly. Okay. Everyone please reply. Gautam, Vasantara, Nithaji. Okay. Chal. Let's start. So my dear students, now we are doing what? We are now starting with your practical problems and I want every one of you to please come to the first practical problem. Gamma Limited has 5 lakh rupee one ordinary share whose current ex-dividend market price is rupee 1.5. Okay, so ex-dividend. What is the meaning of ex-dividend? Can I say after the dividend per share? Okay, so that is the market price which is given to that is 1.5. Always remember that. even if the cum dividend price per share is given to you now, we have to convert that into X dividend by subtracting whatever is your dividend per share. Okay. The company has just paid a dividend of rupees 27 paise per share, and the dividends are expected to continue at this level for some more time. If the company has no debt capital, compute the weighted average cost of capital. Okay. So now in this particular question solution, what are you going to do? We are required to calculate what should be your KE. Come on, calculate your KE in the meanwhile. What is your KE? Okay, so your final answer is nothing but what? 18%. I hope you all have got this answer. Come on here. So this is nothing but 18%. Sure, confident? Okay, so there was nothing in this particular question. We just had to take dividend and we had to divide that by market price and we multiplied that by 100. We got your KE. Okay. Can I say this was nothing but dividend yield approach? Did you just check? Dividend yield approach. Your dividend was constant till perpetuity and there was no growth rate which was given to you. So that's why this is called as your dividend yield approach, and the formula for that is DPS upon MPS into 100. Okay. Chalo, let's start now with the second question. Now, what is given to you in your question number 2? The following details are provided by GPS. We have equity share capital, then we have 12% preference shares, we have 15% redeemable debentures, we have 10% convertible debentures. The cost of equity for the company is given to 16.3 and the income tax rate is 30%. We are required to calculate the WACC. How will you calculate your WACC? Same process, we have to prepare one table. Okay, and in that table, we'll be having what? We'll be having sources of funds, then we'll be having your amount, we'll be having weights, after tax, cost of capital and WACC. So how many sources do we have? We have equity, we have preferences, we have debentures, we have convertible debentures. Do we have the amount available for everything? Come on, yes or no? Yes, sir. So this is the total amount which is available. And we'll be calculating a WACC. And then what is the cost of capital? So for equity share capital, they have given to you 16.3%. So that is readily available. So we are going to just write down 0.163. Okay. Now for preference shares, can I say 12% will continue to remain as 12% only? Because there is no tax benefit which we get in your preference shares. But guys, when we are talking about your redeemable debentures, please tell me, have they given to you your life of the debenture? Just check the question. Have they given you the life of the debenture? So now in this particular case, if the life of the debenture is not given to you, we'll be using redeemable or irredeemable. Though they have told redeemable, but the life is not given to you. So that's why irredeemable debenture. So same concept, we have 15% your rate given to you. We can simply take 15% into 1 minus tax rate of 30%. So that will give you nothing but 10.5%. Okay. And what about convertible debentures? Same concept. 10% is the cost which is given to you. And post tax, it will be nothing but 7%. So then we have to calculate your WACC. So that will be 13.99%. Are you guys okay with this? Okay. Chalo. So with this, my dear students, we are done with your question number 2. Now I want you to please come to your third question. Okay. Now see what's given to you in your question number 3. ABC's company equity share is quoted in the market at what? Rupees 25. Okay. And the company pays a dividend of rupees 2 per share. And the investors market expects growth rate of 6% per annum. Now, when the company pays a dividend of rupees 2 per share, now what should you treat this as? Should you treat this as a D1 or should you treat this as D0? Then the answer is we should treat this as D0. Okay, so this is your D0, which is nothing but rupees 2 per share, and the investors market growth rate is nothing but what? 6%. What is required to be calculated? We are required to calculate what would be the company's cost of equity. How will you calculate your KE? Come on fast. Can I say 2 rupees? To this, we should add the growth rate of 6%. Market price is 25 into 100 plus 6%. So fast, do the calculation. Give me the answer. What's your KE which you are getting? So your answer is coming as 14.48%. First part is done. Very easy. Second part. If the company issues 10% debentures of the face value rupees 100 and realizes rupees 96 per debenture. Can I say realizes rupees 96 per debenture is nothing but your net proceeds? This is the amount which you are realizing. while the debentures are redeemable after 12 years. So what's the life of the debentures, everyone? 12 years. So is this going to be your redeemable debentures bigger formula? Come on, yes or no? Yes, sir. And they are redeemable at a premium of 12%. Calculate cost of debenture using which method? YTM method. So I told you one shortcut. What was the shortcut, everyone? First, we can use the formula. Okay, what's the formula, beta? KD. Everyone tell me, what's the KD? Interest into 1 minus tax. What's your interest on 10% on the face value of 100 each? So what's your interest, everyone? 10. What's your tax rate? 50%. What's your redemption value? Are we redeeming this at a premium? Come on, yes or no? What's the premium, guys? 12%. So 12% premium, it means your redemption value will now become what? 112. Your net proceeds is nothing but what? 96. What's the life? 12. Life is 12 years, no? And divide that by 112 plus 96 upon 2. Give me the answer, guys. What is the answer which you're getting for your KD? Come on, fast. 6.09. So now, yes, you can take it somewhere between 5% and 10%. Absolutely perfect. So you can take between 5% and 10%. Can I say you will be getting your YTM approach, and based on that you can calculate this? Come on, yes or no? Yes, sir. What's the total amount which you have to receive? 96. So 96 is your net proceeds and we have to recover that 96 rupees. Okay. So we have to use YTM approach. What we have done in the previous questions, we are going to continue this further. So then your KD will be coming as 6.45%. So you have to take a range of 5 and 10% and then do that accordingly. So this one was your question number 3. Question number 4. Okay. Now question number 4, let's read this question. Masco Limited wishes to raise an additional finance of what? Rupees 10 lakhs for meeting its investment plans. So it has rupees 2,10,000 in the form of what? Retained earnings, which is available for investment purpose. And further details are as follows. This debt equity mix is what? 3:7. Cost of debt is given to you, which is up to 1,80,000 and beyond 1,80,000. Earning per share is given to you, and then we have dividend payout ratio. We have expected growth rate of dividend, which is 10%. Market price per share is given to you as 44 and the tax rate is given to you as 50%. Determine the pattern for raising additional finance. That's the first part of the question. What's the first part, beta? We are required to determine pattern for raising additional finance. So now, my dear students, question number 4. Can you please tell me how much amount is required to be raised, beta? 10 lakhs. So ये 10 lakhs में से now we have to divide into 2 parts. We have to take debt, we have to take equity. So debt should be what? 30%. Equity should be what? 70%. So can you please tell me 10 lakhs debt, 30%, what will be the amount of the debt, guys? 3 lakhs. And what will be the amount of the equity, guys? 7 lakhs. Okay. And in your equity also, do you have some retained earnings or no? What is the amount of the retained earnings which we have? So your retained earning is nothing but 2,10,000. So what is the amount of equity share capital? Can I say that is nothing but 4,90,000? Come on, yes or no? Yes, sir. So the equity share capital will be 4,90,000. And in this amount of the debt, we have your up to 1,80,000. So can I put it like this? Up to 1,80,000. What's the rate of interest, guys? 10%. Come on here. And then what about the balance part? 1,20,000. And for that, how much percentage rate we have to take into consideration? 16%. Okay, are you guys understanding this? Okay. So this is a pattern of raising the additional finance, which is the first part of the question. They have asked you the pattern for raising additional finance. This is the pattern which you can show it even in your examination. Absolutely fine. What's the second part of the question, guys? We are required to determine what should be the post-tax average cost of additional debt. So we are required to calculate post-tax average cost of additional debt only for the additional debt. So for the additional debt, my dear students, can I put it like this, that we are having sources of funds, amount, weights, after tax EOC, and then the last part will be what? WACC. Can you give me what is your sources of funds, beta? Can I say there is 10% debt and then there is 16% debt? What's the amount which we have? We have 1,80,000 and then we have 1,20,000. Can you please give me what's the total amount, guys? 3 lakhs. So can you give me the weights, guys? 0.6, 0.4, total should be 1. Now, how do you calculate your after-tax cost of capital? Now, to calculate after-tax cost of capital, that is KD, we have to take interest into 1 minus tax. We can directly do it because there is no net proceeds applicable here. So we can directly take the rate and multiply that with what? 1 minus tax rate, you will be getting the answer. What's your interest rate, guys? 10%. 1 minus what's your tax rate? 30%. 50%. Yeah, it's 50%, right? So what is this going to be, beta? 5%. So your KD will be 5%. Solo yaar. And what is going to be this KD? 8%. So then you'll be getting your overall weighted average cost of capital. So what is this going to be? 3. And this is going to be 3.2. Your total is going to be what? 6.2%. Is that going to be your KO? Come on, yes or no? Yes, sir. This is going to be your overall cost of capital. Matlab, this is pertaining to your KD only related to your additional debt. It is any additional debt which you are raising, the cost is going to be what? 6.2%. Now, what's the third part? What is the cost of retained earnings and cost of equity? Please tell me, how will you calculate KE? Can I say D1 upon P0 into 100 plus G? Now, do you have your last year's dividend? Just check, we have earning per share which is 4 and dividend payout is 50%. So on 4 rupees, we are paying 50%. So this is 2, right? And what's the growth rate which they have given to you in the question? The growth rate which they have given in the question is what? 10%. What's the market price per share? 44. And into 100 and plus the growth rate is 10%. Give me the answer. 15%. So can I say if my K is 15%, what do you think is going to happen to my KR? Can I say my KR is also going to be dash? Can I say your K will be equal to your KR? That is going to be 15% only. Hello? You didn't got this. So your KE, KR both are going to be the same. And that is nothing but your 15%. Next, what is the last part? Compute the weighted average cost of capital after tax of additional finance. So now in this particular case, your fourth part is calculation of KO. How will you calculate KO, guys? So we'll be having sources, amount, we'll be having weights, then we'll be having after tax COC, and the last thing which we'll be having, that will be called as your WACC. Can you please tell me how many sources are there? So just check. So we have just checked, there is 10% debt, 16% debt, and now I will take retained earnings also, I will take equity share capital also. Though the cost is same, we can combine it also, but I'm just taking 4 individual costs because there is 4 sources which we have determined. Okay. So here we are having 10% debt. What else? 16% debt. What else? Retained earnings. What else? Equity share capital. I can do it in much more summarized format also by just taking debt and by taking equity, because anyway the cost is the same only. Okay. But just taking a longer route, this is 1,80,000. How much is this? 1,20,000. What's your retained earning? 2,10,000. What was your equity share capital? 4,90,000. What's the total amount? 10 lakhs. Can I say based on this, now I'll be getting the weights 0.18, 0.12, 0.21, 0.49. Do I have every source cost available? Come on, yes or no? Yes, sir. So the moment you do this, you'll be getting your KO, which is overall cost of capital. Superb. Okay. Everyone understood this? Okay. So with this, we are done with your question number 4. Now let's do your question number 5. Determine the cost of capital of best of luck using the book value and using the market value from the following information which is given to you. Now we are having book value and market value. Just check. Are we having equity share capital, retained earnings, preference shares, debentures? And then we are having book value and market value. Additional information is given to you, in which they have told you that equity shares will be quoted at rupees 130 per share and a new issue will be priced at rupees 125, which will be fully subscribed, and flotation cost will be rupees 5 per share. Now in this adjustment, the institute has done one mistake, which I'll show it to you in the solution. Okay. Dividend, they have told you during the 5 years is steadily increasing from 10.6 to 14.19, and dividends at the end of the current financial year is expected to be rupees 15. That is called as your D1. Preference shares, 15% of the preference shares with the face value of 100 would realize 105. And debenture, the company proposes to issue 11-year 15% debentures, but the yield on the debentures of similar maturity and the risk clause is 16%. Flotation cost is 2%. Corporate tax is given to you 35%. Ignore dividend tax. Flotation cost would be calculated on face value. This is specifically told you. Okay. Now we are required to calculate using what weights beta? Book value also and using your market value also. So can I say again we have to prepare how many tables? How many tables we need to prepare? 2 tables we need to prepare. Come on, yaar. So we'll be preparing book value and market value. But what about the cost? Do you think that the cost is going to remain the same? Hello? Whether it is book value weights or whether it is market value weights, is your cost going to remain the same? Come on. Yes, sir. So I want you all to do this along with me. Go to your notebooks. Let us practice this question. This is now solution to question number 5. Okay, are you all ready? So first give the heading. Calculation of WACC using what? Tell me. Book value weights. What will be the heading? Sources, amount, weights, after tax COC, and the last one is what beta? WACC. Okay, na? Now, how many sources are there? We are having 4 sources. What are the 4 sources? Equity share, reserves and surplus, preference shares, and debentures. What is the amount which you have? 120, then 30 lakhs, then next 36 lakhs, and then 9 lakhs. Okay. Do the total. 1 crore 95 lakhs. Okay, what are going to be your weights? Is this right? 1 crore 95 lakhs? Hello? Okay, now what is going to be your weights? 1 crore 20 lakhs, divide that by 1 crore 95 lakhs. What are you going to get? 0.62. Correct? Then 30 lakhs, divide that by, so this is going to be 0.15. 36 lakhs you divide by this, it will be 0.18. And 9 lakhs you divide by this, you will be getting what? 0.05. Come on here. These are going to be your weights. Similarly, we also have to calculate calculation of WACC using what beta? Using what we are going to take? Market value. Hello? We'll be having sources, amount, weights, after tax COC, and the last one is what? WACC. Correct? Now in this particular case, what is your sources, what is your details given? Equity share capital. Now please tell me, in this question, will your KE and KR be the same or KE and KR will be different? In this first, by reading the first adjustment, will the KE and KR be the same or KE and KR is going to be different? Of course, it's going to be different. Why? Because there is flotation cost which is given to you. So what are you going to do? You will be having, once again, equity share capital, reserves and surplus, preference share capital, and your debt. But now we have to write down all the market values. So preference shares market value is what? 33 lakh, 75,000. Come on here. And what about your debentures? 10 lakh, 40,000. Now, what is the market value of equity, guys? 2 crores. But this 2 crores needs to be now apportioned. In which ratio? Can you tell me which ratio will you apportion this to? Can I say we are going to apportion this on the basis of the book value of equity and reserves? Yeah. Right? So this 2 crores, what we will do? We will apportion in equity and reserves and surplus in the ratio of 120 and 30. So that is nothing but what? 4:1. So that is going to be what? 4 by 5 and 1 by 5. So this is going to be 1 crore 60 lakhs and this is going to be how much? 40 lakhs. So this is going to be 1 crore 60 lakhs and this will be 40 lakhs. Give me your total amount. Give me the total amount. Two crore 44 lakhs 15,000. Now what are your weights? Tell me. First I will take 2 crore 14 lakh 15,000 and now 1 crore 60 lakhs. I have to divide by this, so it is going to be 0.66. Come on here. This is now going to be 0.16. This will be 0.14. And the last part 0.04. Okay. The total should be 1. So are we ready with all the weights? Come on, yes or no? Yes, sir. Now what is to be done next? We have to calculate after tax of cost of capital. And can I say after tax cost of capital is going to be different for your KE and KR. Okay. Now in this particular question, the first thing is they have not given you growth rate directly. They have just told you that during the last 5 years now, dividend has increased from 10.6 to what? 10.6 to 14.19. But have they given to you at what rate is it increasing? No. So can you please tell me what's the formula for amount? Can I say A is equal to P into 1 plus I raised to the power n? So here, now what is the amount which is going to happen? Can I say after the end of 5 years the amount is going to be 14.19 here? Hello? 14.19. Now what is going to be your principal beta? Your principal is going to be what? 10.6 into 1 plus I raised to the power 5. So you take 14.19 and divide that by 10.6. What is the answer which you're going to get? 1.3387 is 1 plus I raised to the power 5. Now we have to calculate the fifth root, but not possible on a normal calc. But my dear students, can we do this with the help of the table? Come on, yes or no? Yes. We can definitely take the help of a table to calculate it. Now we just have to check the same FVIF. And in this FVIF table, please check what's the life beta. The life is 5 years. So I just have to look at this row. Okay. And now as you all can see that, yahan pe you all can just check that we have this as 1.338. Search if there is a 1.338 directly available or not. So is it directly available? Just check. Yes. Can you just check at the rate of 6%? It is directly available. So can I say that my growth rate is going to be what, beta? 6%. I hope you guys are trying to understand. See, this is the exact amount, 1.338. Okay. So on this basis, can I say that we are now getting your growth rate, which is nothing but 6%. Okay. Now, what is going to be your KE calculation? Can I say KE is nothing but D1 upon net proceeds? Hello? Into 100 plus G. Can you please tell me what's your D1 beta? Last year's dividend plus or growth rate. What was your last year's dividend? Just check. Dividend at the end of the current year is expected to be 15. So this is just dividend at the end of the current year. This is not dividend. This is D0 or this is D1. Dividend at the end of the current financial year. What will you treat this as? This is fifth. No? Hello? So that will be treated as your what? D1. Because dividend at the end of the current financial year is expected to be. Can you see the wordings? So this is last year's dividend or this is going to be next year's dividend. Now this is very important to identify because growth rate depends on it. So are we going to add any growth rate to it or there is no growth rate we have to add? No growth rate. So this is going to be what? 15. What's the net proceeds, guys? The net proceeds is going to be, we have issued it at 125 and flotation cost is 5. So can you please tell me 125 minus 5? What will this give you, beta? 120 into 100 plus what's the growth rate? 6%. Chalo, give me the answer. This is coming as 18.5%. Everyone is getting the KE as 18.5. Hello. So now I have got my KE. Can I substitute KE as 18.5? 18.5. 18.5. Let's talk about KR. Can you please tell me now in KR calculation, I will take D1 upon what? P0 into 100 plus G. That's how I'm going to calculate your KE. So can you all please tell me what's your D1 beta? 15. But what should be the market price? Then the market price are quoted at 130. So you have to divide that by 130. This is where institute has made a mistake. Give me the answer. What is the answer which is coming? 17.54%. So this is your KR, 17.54%. Can I go and substitute my KR also? Come on, yes or no? Yes, sir. I can substitute my KR also 17.54%. Now here what ICAI has done is, by mistake now they have taken here 125. It should not be 125. What it should be? It should be nothing but your, how much percent? They should be 130 rupees. This is the error. In the illustration which we did, illustration 12 or something, in that they had taken market price only. But here it's a mistake. Okay. Convinced everyone? Okay. Next, after that, what's the next thing which we have? 15% preference shares with a face value of 100 would realize what? 105. So now please tell me, KP redeemable or irredeemable, everyone? Is the life given to you or life is not given? So then that particular case, what I will do? I will simply calculate my KP. How will I calculate KP, guys? Can I say that is PD upon net proceeds into 100? What's my PD, guys? 15. Because 15% of 100 is 15 rupees. What is the net proceeds? 105. They are given in the question. It is nothing but 105. So give me this. 14.29%. Can I now substitute my KP, which is 14.29%? Do you guys get this? 14.29. Now what's the last thing? The last thing they have told you that debentures, the company proposes to issue 11-year 15% debentures, but the yield on the debentures of similar maturity and risk class is 16%. Flotation cost is 2%. Now, what we want to do is, we want to issue the debentures. See, if in market now people are buying debentures and they are getting 16% rate. If I issue debentures at 50% rate, will people buy my debentures? Because already there is someone who is selling this particular debentures and providing the interest rate of dash. My competitors are providing 16. But if I issue the debentures at 15%, what do you think people will subscribe to it? No. So to make them subscribe, don't you think I should issue those debentures at some discount? Because only if I issue a discount, people will buy my debentures. Come on, yes or no? Yes, sir. So what is going to be my issue price? So see, what am I going to do is, can I say on face value 100, dividend of 16 is given. Now in this particular case, if I keep 15% rate, so what should be my issue price? On 100 rupees issue price, the interest which is being given, that is 16. Come on, yaar. The interest given is 16. But if I am providing 15, then what should be my issue price? 15 into 100 divided by 16. How much is this? 93.75. So can I say my issue price should be 93.75. But don't you think from the issue price I also have to subtract dash? Flotation cost. So now what is the flotation cost? They have mentioned beta. They have mentioned flotation cost of 2%. 2% of the face value 100. So 100, because they have only told you now that flotation cost is nothing but 2%. So that is going to be your 2 rupees. So what is going to be your final answer, beta? So this should be treated as your net proceeds. And by the way, it proposes to issue 11 year. Can you please tell me now, KD will be calculated using a smaller formula or bigger formula? Bigger formula, right? KD redeemable. What is your interest, everyone? What's your interest? Just check. Huh? 15%. So this is going to be 15 into 1 minus. What's your tax rate? 35%. Plus, what's your redemption value? Par 100. Net proceeds is 91.75. Life is 11. And you divide that by 100 plus 91.75 divided by 2 into 100. Give me the answer. What's your KD? %10.17%. 10.95 is the answer. 95 only is coming, na? 10.95. So this is your KD 10.95. So then can I substitute here 10.95% on yes or no? Yes, sir. And this will actually help you to calculate your KO. I'll be getting my KO. Okay. So very easy, beta. I hope you have understood how do we calculate this. Sure, confident. Okay. Chalo, good. Now let us start with the next question. Question number 6. Okay. What is given to you? Kalyanam Limited has an operating profit of 34 lakh 50 and it has employed debt which gives total interest charge of 3 lakh 75,000. Guys, operating profits is also called as your dash EBIT. And the firm has an existing cost of equity and debt which is 16 and 8. And the firm has a new proposal before it which requires fund of 75 lakhs and is expected to bring an additional profit of what? 14 lakh 25,000. To finance the proposal, the firm is expecting an issue of additional debt of 8% and will not be issuing any new equity shares in the market, assuming no tax. You are required to calculate WSCC before the proposal and after the proposal. Okay. Now, how will you approach this particular question? See, guys, in this particular case, what are the two sources? Okay, just check. What's the amount of the EBIT which they have given? This is now solution to which question? 6. What is the amount of EBIT which you have? 34 lakh 50. Okay. And also at the same time, they have employed a debt which gives an interest charge of 7 lakh 50. So we have the interest charge which is 7 lakh 50. Hello? Okay. But do you have the amount of debt available? I'm asking you, do you have the amount of debt available? There is no debt. Till now. The firm has an existing cost of equity of 16%, cost of debt is 8%. So we have your K, which is nothing but what? 16%. And we have your KD, which is given to you as what? 8%. And it has a new proposal before which it requires a fund of what? 75 lakhs. And this will bring the additional profit of what? 14 lakh 25,000. So can I put it like this, that because we are going to raise 75 lakhs, your EBIT will increase by how much amount? 14 lakh 25,000. And to finance this, the firm is proposing an additional debt of what? 8%. And will not be issuing any new equity shares in the market. So can I say entire fund? What is the investment which is happening in the fund? 75 lakhs. Can I say the new funds of entire 75 lakhs is what, beta? Can I say it is nothing but by way of debt? There is no equity in it. How will you approach this? So in this particular case, first we will get the amount of debt. How much is the amount of debt, beta? 93 lakh 75,000 existing debt. Okay, so this cost of debt, now we have to consider this as before tax cost of debt. And anyway, there is no tax rate which is given to you. They have told you there is no tax culture. So that's why can I say whatever is your cost of debt, that itself is nothing but your rate of interest. Come on, yes or no? Yes, sir. Or else there would have been into 1 minus tax. But there is no such data which is given to you. Okay. So based on that, we got first the amount of the debt, 93,75,000. Is everyone okay with this? Okay. What is the value of equity? Now EBIT minus interest, what do you get? EBT. So 34,50,000 minus 7,50,000. How much is this gonna be? 27 lakhs. Is there any tax? Is there any preferences? So all the profits belongs to whom? Come on, yaar. Equity shareholders. And then they have told you that what is the cost of the equity which they have told you, that is 16%. So you just have to take this amount, what we have just now got, 27 lakhs, and divide that by how much percentage? 16%. In case of debt also we are taking interest and we are dividing that by the interest rate. So we are capitalizing it, right? So here also we have the net profits for equity shareholders. We'll capitalize that. How much is the answer? 1,68,75,000. Have I got the value of the equity also? Come on, yes or no? Yes, sir. Now, what is going to be your new KE? See, this is now going to be what? 34,50,000 plus 14,25,000. Can you give me what is this going to be? 34,50,000 plus 14,25,000 after expansion. See, all this is before expansion. After expansion, can I say the EBIT will be 48,75,000? Hello? From that EBIT, what will I subtract? Interest. What will I get? EBT, also known as my dividends. Right? What will be the amount of the interest, everyone? Can I say we have taken new funds at the rate of what? 75 lakhs. What's the rate? 8%. So 75 lakhs multiplied by 8%. How much is the interest? 6 lakhs. And how much was my old interest? 7,50,000. Now I am doing it after expansion. This is after proposal. So that is going to be 13,50,000. So 48,75,000. I will subtract it with what, beta? 13,50,000. What am I going to get? 35,25,000. Hello? Are you all trying to understand this? So this is nothing but 35,25,000. Now, my dear students, to finance the proposal, the firm, so we are required to calculate what a WACC. Okay. So we have got this as 35,25,000. Okay. And what my new KE? So because there is no further equity which is supposed to be raised, so 35,25,000, if I divide that by what's my value of equity? Your value of equity which is given to you, that is nothing but how much? We have already calculated this above. Okay, you only did it for me, which is 1,68,75,000. So will I get the new KE? Come on, yes or no? Yes, sir. Now, what will be your format? See, sources, amount, weights, cost of capital, WACC. Correct? If I am talking about before proposal, so can I say there will be debt and equity both? What was the amount of the debt we got it through capitalization? 93,75,000. So, yaar. And what is going to be the amount of equity? We got this as 1,68,75,000. Come on. What was your cost of capital debt? 8%. And equity before proposal was what? 16%. Can I calculate the amount, weights, WACC? Right? Is this part okay? Will I be able to get it? Okay, so if I give you interest amount and if I give you rate of interest, can you calculate value of debt? Come on, yes or no? Yes, sir. Similarly, if I give you dividend amount and if I give you along with dividend, your capitalization rate, that is KE, can I say we'll be getting the market value of equity? Come on, yes or no? Yes, sir. So this is before proposal. After proposal also we have debt and equity. So what is going to be your debt? Now our debt is going to be increased. Hello? 75 lakhs old and 93,75,000 old and 75 lakhs new. So please take 93,75,000 and add 75 lakhs to it. So can I say this is going to be 1,68,75,000. Correct? And value of equity I just now got. What was the value of equity which I got? 1,68,75,000. So can I say this is going to be 0.5, 0.5. This is 8. And the new KE which I've got, that is nothing but 20.9%. Will I be getting the WACC? Come on, yes or no? Yes, sir. You'll be getting the WACC. See, half of proportion, 14.45. Are you okay with this? Okay. Last question. Question number 7. A company issues 15% convertible debentures of rupees 100 each at par with a maturity period of 6 years. So guys, this particular debentures is going to be redeemed when beta? It is going to be redeemed after the period of 6 years. But what have they told you? On maturity, each debenture will be converted into 2 equity shares of the company. Matlab at the end of the 6th year, can I say, are you going to get cash or are you going to get equity shares? And for one debenture, how many equity shares are there? For one debenture, there is 2 equity shares. Risk-free rate is 10, market risk premium is 18, and the beta is 1.25. Can you calculate KE, guys? Come on. Can you calculate KE? What would be the formula? RF plus what? RM minus RF into beta. Bolo yaar. What's your RF, everyone? 10. What's your RM minus RF? They have told you market risk premium, which is that 18%. What's your beta, guys? Your beta is nothing but, they have told you in the question, how much is it? 1.25. Is this sufficient for you to calculate your key? What's your key? 32.5%. Hello? 32.5%. Is this your KE? Come on, yes or no? Yes, sir. Just check. Your KE is coming as 32.5%. But then what have they asked you? The company has paid a dividend of rupees 12.76 and 5 years ago it paid a dividend of rupees 10. Flotation cost is 5%. Okay. Now you are required to calculate what is the cost of convertible debentures using the approximation method. Now approximation method means that formula which I told you. This formula is nothing but approximation method. Can you just check this formula? This is nothing but your approximation method. Okay. So how do you calculate your KD? Interest into 1 minus tax. Plus, instead of RV, I will write down conversion value. Why will I write down conversion value? Because at the end, are you going to get it converted into cash or you are going to get it converted into shares? Shares. So conversion value minus net proceed upon what? N, and divide that with what? Conversion value plus net proceeds upon 2. Solu yaar. Okay. What's going to be my amount of interest? Just check. So can I just check that the interest is what? 15% of face value 100. So it's going to be 15. What's the tax rate, everyone? Tax rate, 40%. Now I need conversion value. So what have they told you next is that you are having one debenture is equal to how many number of equity shares? 2 equity shares. But I don't have what should be the price of this particular equity share. But now I can calculate this price. First, I will calculate P0. What is the current market price today? Only if I have current market price today, I will be able to calculate what can be the price at the end of 6th year. We did one question on convertible, example 3, in which we had to calculate what should be the conversion value. Do you remember I told you the price today is this much, 153.12, the answer. So the same thing is applicable here. First I should get what should be your P0 and then I'm going to add the growth rate for how many number of years? 6 years. Then I'll be getting conversion value at the end of the 6th year. So how do you calculate P0? See, as per dividend yield approach, what is KE? D1 upon P0 into 100 plus G, right? So if I want to calculate P0, I'll take first year G. So this is KE minus G is D1 upon P0 into 100. Solo here. So if this P0 will go here, so can I say this will now become what? D1 upon KE minus G. That's how I can calculate the price today. Come on, yes or no? Yes, sir. Can you please tell me what was your last dividend? the company has paid a dividend of 12.76. Okay, and they have told you that the 5 years ago the dividend was 10. Okay. So first I'll write down here 12.76 plus I have to add the growth rate. The K which I just now got was how much? 32.5. Hello? And I need to just calculate the growth rate. Now how will I calculate the growth rate? See, they have told you that 5 years ago it paid a dividend of what? Rupees 10. So amount is equal to principal into 1 plus I raised to the power n. Okay, 5 years ago I had paid a dividend which was how much? Rupees 10. What is this? Price has now become 12.76 into 1 plus I raised to the power 5. Okay, it's coming as 5%. 1.276 is equal to 1 plus I raised to the power 5. So your I is coming as 5%. So can I write down this as 5%? Come on, yes or no? Yes, sir. So I can get my P0. So what's my P0? Can you please calculate this for me? 12.76 plus 5% will give you 13.398 upon 32.5 minus 5. That is nothing but 27.5. So now this will be 13.398 divided by, this is percentage. Okay, you can write down into 100 also, or you can write down your percentage also. Divide by this percentage will give you 48.72. Now how many equity shares are going to get? 2 equity shares. But wait, this is just your dash. Is this your P0? Come on, yes or no? Just check. Your P0 should be coming as, how much is it coming? Actually, they have directly done like this only. Okay, no problem. So, okay. So now, my dear students, there are 2 ways to do it. Okay, but what we will do is, chalo, everyone is okay with this much part first. Okay. Now, just do one thing. Add growth rate 5% for 6 years. Just do that. 1, 2, 3, 4, 5, 6. See, same answer, 65.28. Are you getting it? So what you can do is, you can take 48.72, but this is the price what? This is the price today. I want the price at the end of which year? 6th year. So what is going to be the price at the end of 6th year? If I take 48.72 and add growth rate, how much is it? 5% for 6 years. In example 3, we did it like this only. That's why I'm following this method. So which is 48.72 into 1 plus 0.05 raised to the power 6. So that will give you 65.29. So this is 65.29. This, because I've got the P0 first. Because P0 was not given to you, na. They had told us that, okay, 5 years ago this was the dividend. Right now this is the dividend. Based on that I calculate the growth rate. But I want P0. P0 was not given to, so I calculated P0 first. And once I calculated P0, now the growth rate is dash 5% for how many number of years? 6 years. So will that give you your final answer? Come on, yes or no? Yes, sir. So much is this figure coming, beta? 65.29. Are you clear? Okay. So this rupees 65.29 is what? 1 share. Price is 65.29. How many shares am I going to get? 2. So you multiply this by 2. How much is this going to be? 130.58. So what is 130.58? This will be called as my conversion value. So which is 130.58. Got it? Okay. Flotation cost, they have told you 5% of the issue amount. So 100 rupees at par. So this is going to be what? 95. What's the life? 6 years. And this will now be 130.58 plus 95 upon 6 into 100. So I first calculated what is going to be the price, and based on that we calculated, we'll be getting the final answer, which is nothing but what? 13.24%. Superb. That's going to be our KD. Have you all understood this calculation, guys? Okay. So first I calculated P0 because P0 was not there in the question. So first I calculated a P0 and then I calculated the price at the end of the 6th year. Okay. We are also required to calculate YTM method, cost of preference shares. Now this is something which you have done it many number of times. So you'll be able to do it. Okay. So using IRR method, we just have to calculate it. What is going to be my P0? Flotation cost is 6% of the issue amount. So 94. So you should try and get 94 rupees. series of cash flows will be given to you. You use trial and error method, you'll be getting the answer. Okay, everyone is convinced? With this now, my dear students, finally, a very big chapter gets over. And that is your cost of capital. Understood, everyone? Sure, confident? Purinjida? Arthamainda? Okay. Now we are going to start with a new chapter. We'll take break of 5 minutes. After that, we'll start. With a new chapter, we'll start. Check. Okay. Sure, my dear students. We'll continue this further. Okay. Now we are starting with a new chapter, and that is financing decisions, capital structure. Okay. Now see. This chapter now basically has two important parts. This capital structure chapter has two important parts. Okay. The first part now is ideally your selection of financial plan. Okay. Then what is going to be your indifference point and what is going to be your financial break-even point. And the second part now is called as your capital structure theories. Okay, these are the two important parts. Okay. Now, when it comes to selection of a financial plan, please tell me the company is going to raise the finance from one source or from multiple sources? Multiple sources. Can I say a company can have various proposals in front of them for the purpose of raising finance? Come on, yes or no? Yes, sir. What are the various proposals for the purpose of raising finance? Can I say a company can have a proposal in which they can raise the finance by debt equity, or else there can be debt equity and preference shares, or there can be only equity. There can be different proposals. Come on, yes or no? Yes, sir. Can we select all the proposals for the purpose of raising finance? Then the answer is no. You have to carefully select a particular proposal which can be either on the basis of EPS or either on the basis of MPS. Which proposal will you select? Can I say you will select the proposal in which your EPS is going to be maximum, or you will select the proposal in which MPS is going to be maximum? Okay. So how do we realize that which proposal should we select on what parameter? So if P ratio is given to you in the question, what is given to you in the question? Tell me. P ratio. Then we will select a particular financial plan in which what should be maximum, beta? MPS should be maximum. So whenever MPS per share is going to be higher, can I say we select that particular proposal? Come on, yes or no? Then the answer is yes. Okay. Now, considering this, let's say for example, my dear students, if I tell you that if you need 10 lakh rupees, and with the amount of 10 lakh rupees, suppose you have a capital of 2 lakh rupees. You are raising an EBIT of 2 lakh rupees. Okay. What is the amount which you have invested, beta? 10 lakhs. You want to invest in a particular project, 10 lakhs. How much is the returns which you are generating? Tell me, 2 lakhs. So can you all please tell me what's the amount of the EBIT, guys? What's the amount of the EBIT which you're generating from the project? 2 lakhs. Now, from this amount of EBIT, what do you subtract? Interest. What do you get? EBT. What do you subtract? Tax. What do you get? NPAT. From NPAT, what do you subtract? Preference dividend. What will you get? Net profit for equity shareholders. This, if I divide the number of equity shares, what do I get? The EPS. So can I say EBIT will be the same throughout? For any particular financing plan we want to select, can I say your EBIT has to be constant? Come on, yes or no? Yes, sir. But depending upon the different type of plans, your interest will change, tax, etc. We'll be getting the EPS and I'll multiply that with what? PE ratio. So ultimately get what? Market price per share. And we will select the plan in which the MPS should be maximum. Okay. But what is the meaning of the word indifference point? So indifference point is that level of EBIT. What is indifference point? That level of EBIT at which your EPS should be same. Your EPS should be what, beta? Your EPS should be same. So it is that level of EBIT at which what should be same, beta? EPS. Your EPS should be same. But come out mein, your EPS should be same. So your EPS of plan 1 should be what? Equal to EPS of plan 2. So in indifference point, what do we calculate? We calculate that level of EBIT at which what should be the same beta? EPS should be same. And that is something which we calculate by using EPS of plan 1 should be equal to your EPS of plan 2. So what is the formula we are going to use? EBIT minus interest into 1 minus tax minus preference dividend. I will divide that with what? Number of equity shares. So this should be equal to EBIT minus interest into what? 1 minus tax minus preference dividend upon number of equity shares. Then we will find your EBIT by considering your EBIT to be S, and we will get that level of EBIT at which your EPS should be dash. Your EPS should be same. That is something which we call it as your indifference point. Now, my dear students, what is the basic meaning of financial break-even point? So financial break-even point is also that level of EBIT. So in financial break-even point also, what are we calculating? Tell me. EBIT. But at which your EPS should be 0. So because it's a break-even point. So what is break-even point? No profit, no loss. So your EPS should be what? 0. So we have to calculate that level of EBIT at which your EPS should be 0. So first of all, have you all understood this first 3 parts? What are the first 3 parts? We are going to learn how to select a financial plan which can be either on the basis of, which can be either on the basis of EPS or MPS. If P ratio is given to you, we always select a financial plan on the basis of what? MPS. Okay? And everything should be lower the better or higher the better, beta? Lower or higher? We'll always select the plan in which your EPS or MPS should always be higher. Indifference point. What is indifference point, everyone? It is that level of EBIT at which your EPS should be dash. Your EPS should be same. Your EPS is going to be same. So it is that level of EBIT at which your EPS is going to be what? It should be same. And what about your financial break-even point? It is that level of your EBIT at which your EPS should be dash. Your EPS should be 0. Your earning per share should be 0. So these are the 3 important things which you have to understand. Okay. Now, what is capital structure theories then? Now, capital structure theories, this is now first we will learn how do we calculate your financial break-even point. So to calculate the financial break-even point, we have to take the fixed financial cost, that is interest plus preference dividend, and we divide that with what? 1 minus tax. Because can you all please tell me that preference dividend is always given before tax or preference dividend is given after tax? So that's why we have to divide that by 1 minus tax. So we'll be getting the final answer, and then interest plus whatever is preference dividend on 1 minus tax will be grossed up, and both the things put together that will actually give you your financial break-even point. Okay. So this is the first 3 parts. Okay. Now we are going to deal with the capital structure theories. Okay. Before that, let me just check. Okay. If they have given you any questions now. Okay, no. We are required to calculate these approaches only. Okay. So first, I will now start one by one approaches. I'll teach you and then we'll proceed further. Okay. Now pay attention. I'm explaining you capital structure theories. Okay. Everything in next 15 minutes. So pay attention to this. Okay. Capital structure theories. See, every theory in finance has some particular objective. Every theory has an objective. Okay. Like even in a scientific theory also, they will also have some objective behind it. So what is the objective of capital structure theories? Now it is to check that if you change the capital structure, should your WSCC change or not? Should your KO change or not? So capital structure theory is actually used for what, beta? It is used for checking that if you change the capital structure, your KO should change or not. Okay, whether your KO should change or not. So change in capital structure should have an impact on your KO or not. Okay, so for example, we have debt and equity. The ratio is 0.2, 0.8. Suppose this is 10%, this is 15%. What is going to be your KO, guys? Can I say this will now become 2%, this will become 12%, this will become what? 14%. Now, if I change this to 0.4, 0.6, what do you think? Will the KO remain the same or KO will change? Change, right? So there are some theories which tells you that if you change the capital structure, your KO will change. But there are some theories which will tell you that even if you change the capital structure, your KO is going to remain constant. Your KO is going to remain the same. Even if you change the capital structure, what is going to happen to your KO, beta? Your KO is going to remain the same. Your KO is not going to change. Are you guys trying to understand this? Okay. So there are some theories which will tell you that if you change in capital structure, your WSCC will change. Okay. But there are some theories which will tell you that even if you change the capital structure, your WSCC is what? Going to remain constant. It's going to remain constant. Okay. Now in capital structure theories, whenever you are studying now, you have to first understand that there are three assumptions to it. How many assumptions are there in capital structure theories? Three assumptions. The first assumption is there is no income tax. Is there any income tax or no income tax? No income tax. So in entire capital structure theories, will you find any income tax or there is no income tax, guys? No income tax. Second, it is there is no preference share capital. There is no preference share capital at all. And the third is there is no retention. No retention. It means that whatever you are earning, you have to compulsory pay 100% by the way of dividends. So these are the three important assumptions. Okay. Now based on this, what do you think will be my income statement? My income statement starts from EBIT. From EBIT, what do you subtract? What do you get? EBT. But because there is no tax, can I say this EBT itself is your NPAT? Come on, yeah. And if there is no preference shares, can I say this NPAT is nothing but what? Net profit for equity shareholders. And if suppose you are not allowed to retain anything, can I say this amount itself is your what? Dividends. So can I say in capital structure theories, your EBT itself is your dividends. Everyone understood this? Okay. Now, based on these assumptions, if I want to calculate what should be the market value of equity. Okay, what would be the market value of equity? Okay. Now, please tell me, how do you calculate KE under dividend yield approach? Under dividend yield approach, when dividends are going to be constant towards perpetuity, how do you calculate your KE? We take DPS upon MPS into 100. Come on, yaar, because there is no retention, there is no possibility of growth rate. So can I say your dividends are going to be constant towards perpetuity? Come on, yes or no? Yes, sir. So under your dividend yield approach, how do you calculate KE? Can I say by taking DPS upon MPS into 100? Do you guys agree with this? Okay. Now, if I take this MPS here, can I say my MPS will now become what? DPS upon KE. This process is called as capitalization, which we just now did in the last question of cost of capital. You know, where we had to calculate, what was your market price per share, whatever the value of equity, we took that and we divided that by your KE. So that's how, if I want to calculate now, what should be the total market value of equity? How will you calculate total market value of equity? Can I say I will be taking total dividends and I'll be capitalizing that by KE. Will I get the market value of equity? Come on, yes or no? Yes, sir. But now in this particular case, how do you calculate your KO? How do you calculate your KO? So here there is no need to prepare any table. You know, we used to always prepare table to calculate your Q. But in this part, we don't have to prepare the table. We can simply calculate KO by using EBIT upon market value of firm. Market value of firm is market value of company into 100. So we simply have to take what? EBIT upon market value of the company into 100. Now you must be wondering, sir, why do we have to take EBIT upon market value of the company? Because can I say that EBIT minus interest gives you what? EBT. But that EBT itself is your dash, dividends. So whether it is interest or whether it is dividend, your entire EBIT is actually your cost. So you can simply take EBIT and you can divide that by market value of the company into 100. That will give you your Q. Okay. Now please tell me, how do you calculate now market value of the firm now? Can I say your market value of the firm will be nothing but, if I have EBIT, can I say I can capitalize that by Q? Will I be getting the market value of the firm? Come on, yes or no? Yes, sir. Take EBIT and that EBIT you have to divide that with what? Q. That will give you your market value of the firm. Are you guys okay with this? Okay, EBIT upon Q. Now, market value of firm is also nothing but market value of debt plus market value of equity. Now in market value weights also, when you are calculating this, debt, equity, whatever market price, we are writing it down. So this is called as what? Nothing but market value of the firm. So market value of debt plus market value of equity. This will give you market value of the firm. Okay. So first of all, are you all okay with these three assumptions? Based on these three assumptions, are you all okay with the income statement solo? Income statement, everyone, what your income statement will look like? EBIT minus interest. Will that give you your EBT, which is also known as your dividends? What are the three assumptions? Assumption number one, no tax. Number two, no preference shares. And number three, no retention. 100% dividend payout ratio. Okay. Now, are you all okay with how do we calculate market value of equity boss? So whatever is your dividend, you divide that by KE. How do you calculate KO? EBIT upon value of the firm. And if I have value of the firm, I can capitalize EBIT by KO to get the final answer. And then market value of the firm is market value of debt plus market value of equity. Okay. Now, my dear students, let us first understand, what are different approaches. Okay. So now I will first give you a short summary that there are in all 4 approaches. How many approaches are there? 4 approaches in capital structure theories. The first approach is actually called as your net income approach. What is it called as? Tell me. Net income approach. Second approach is called as net operating income approach. Okay, but I will first do traditional approach. Here also they have done traditional. So I will take your second approach as your traditional approach. Okay. Then the third approach is net operating income approach. And the last approach is called as approach. How many approaches are there, everyone? 4. First approach, tell me. Net income approach. Okay. Second approach, traditional. Third, net operating income. And fourth, approach. Now, as per your net income approach, even if you change your KE, KD, your KO will be affected. So will your KO change with the change in the capital structure? Come on, yes or no? Yes. Your KO will change. Traditional approach also tells you KO will change. Net operating income tells you that the KO will not change. And approach has 2 parts. One, it is without tax, and one it is with tax. So without tax also tells you that will the KO change? Then the answer is no. And with tax, will the KO change? Yes, KO will change. Okay. So out of this 5 sub-part approaches, can I say that only 2 approaches, net operating income and approach without tax, only these guys tells you what? Even if you change the capital structure, your KO will not change. Rest all the approaches, what are they telling you, beta? Will the KO change? Come on, yes or no? Yes, sir. KO is going to change. Okay. Now, let us talk about net income approach. Now, what does net income approach tells you? That your KD and KE will remain constant. What will happen to your KD and KE, beta? They will remain, tell me what? Constant. So they are not going to change. Traditional approach tells you that your KE will increase. If you take more and more debt in the capital structure, will your KE increase? Come on, yes or no? Yes, sir. So traditional approach tells you that KE will increase. Okay. Net operating income approach will tell you that KE will definitely increase. Okay. But KO will remain constant. Okay. But KO will remain constant. So basically KE will increase, but KE will increase in such a way that benefit of cheaper debt will be compensated by increase in KE. So KE will increase, but KE will increase in such a way that whatever, when you're taking more and more debt in the capital structure, so whatever benefit we are getting from that, that will be compensated with your KE, and the KE is going to remain constant. And approach without tax tells you that we are going to use arbitrage profits to understand that the value of the company is going to remain the same. And approach with tax tells you that market value of levered company is greater than market value of unlevered company. Okay. I'll explain you one by one everything. Don't worry about it. Okay. But till now, have you all understood at least this much part? Okay. Have you all understood in this chapter, basically how many main parts are there? Tell me. Two main parts. The first part deals with three important sections. What is that? Selection of plan. It can be either on the basis of what? EPS or MPS. Second one was what? Calculation of indifference point. And that is calculating that level of EBIT at which EPS is same. Financial break-even point is also what? Calculation of that level of EBIT at which EPS is going to be 0 because it's break-even. And what is capital structure theories? To check if the change in capital structure will impact WCC or not. How many assumptions are there? 3. First, no tax. Number 2, no preferences. Number 3, no retention. And your EBIT minus interest will eventually give you what? It will give you your EBT, which is also known as your dividends. Okay. Now, my dear students, give me what is market value of equity formula. Can I say that is nothing but total dividend upon T? Have you all understood what is KO? EBIT upon value of the firm. Market value of the firm, we take EBIT, we capitalize by KO. And this is market value of debt plus equity will give you total market value of company. Okay. How many approaches are there? Everyone, please tell me. 4 plus 1. Okay. 4 approaches, 4 main approaches. First is what? Net income. Second, traditional. Third, net operating income. Fourth, MM. And MM has without tax, with tax. Now, let us deal with the first approach, that is net income approach. Everyone, please tell me. Suppose this is debt and equity. If I give you, you're listening to me? Okay. Okay, very good. Suppose there is debt and equity. Okay, can you say straight, please? Wait, madam. There is debt and equity. Okay. Now, suppose we have debt and equity like this. Debt is 0.2, equity is 0.8. What is the total? 1, right? Suppose this is 10%, this is 15%. Can I say now this will be what? 2%. This will be what? 12%. Total should be what? 14%. Now, if I introduce more debt in the capital structure, what do you think is going to happen here? This will be 6. This will be what? 0.6 into 15. 9. So this is going to be what? No, 9, Nina. Sorry, this is 4. 0.4 into 10 is 4. This will be 9. So this will be what? 13. If I introduce more debt in the capital structure, so 0.6 into 10, 6. 0.4 into 15, 6. Can I say this will become 12? So what do you think is happening to the KO? Is the KO first of all changing? And is the KO increasing or decreasing? Because if you introduce more debt, don't you think that debt is a cheaper mode of finance? So debt is cheap. So don't you think that the KO will fall? Come on, yaar. So the KO is definitely going to fall. And what happens when KO falls? Market value of the company increases. So this is the first part, NI approach. Did I change anything in my KE here? No. So now I have a second approach. And the name of the second approach is called as your traditional approach. Now in this traditional approach, will your KE change? Will your KE change? Yes, KE will definitely change. So there is debt and equity. There is debt and equity, okay. Now, suppose your weights is 0.2, 0.4, sorry, 0.8, total should be 1. This is 10%, this is 15%. Okay, and this is 2%. So this will now become what? 12%, this will become what? 14%. Now, if you introduce more debt, 0.4, and I say this will become 0.6. Now they tell you that your debt cost example remains the same. This will be 4% only. But your K is not going to be 15%. Why? Because now you are taking more debt in the capital structure. When you take more debt in the capital structure, what do you think happens to the risk in the company? Will the risk in the company fall or the risk in the company rise when you take more debt in the capital structure? Rise. When the risk in the company rises, more and more people will expect more from you. Come on, yes or no? Yes, sir. So what do you think is going to happen to the KE? Will the KE remain the same or KE will enhance? KE will enhance. So for example, first it enhances initially marginally. So it just enhances by 0.5%. Example. So in this particular case, can I say 15.5 into 0.6? This will give you what? 9.3. So now please tell me what is this? 13.3. So are you getting benefit of cheaper debt? Yes. Because if you are taking debt in the capital structure which is 0.4, don't you think your KO is falling? Though your KE has enhanced, but still you are getting benefit of cheaper debt. But if you take more debt, if you take this as 0.6, then can I say 0.6 into 10 is what? 6%. But suppose now this KE increases drastically. Suppose it becomes 30%. So 30 into 0.4 will become what? 12. So now what do you think has happened to your KO? 18%. Now please tell me, what do you think has happened to the KO? Has the KO reduced or the KO has increased? Can I say from 14 to 13.3 to what? 18. So under traditional approach, don't you think this is called as your optimum capital structure? What is it called as? Tell me. Optimum capital structure. Optimum means this is the best capital structure. So at this capital structure, you know, the KE has also increased. So equity shareholders are also happy. The KE benefit of cheaper debt, you have also got it. KO has reduced. Don't think your market value is maximum in this approach? Come on, yes or no? Yes, sir. Understood? Third is something which is called as net operating income approach. Now what does net operating income approach tells you? Suppose this is 0.2, 0.8, this is 1. Suppose this is 10%, this is 15%. So this is what? 2%. This is 12%. So this has to be what? 14%. Okay. Now you introduce more debt. Suppose you take this as 0.4. Now what does NOI tells you? That at all levels of debt in the capital structure, your KO is going to remain dash. KO is going to remain the same. So can I say if this is 0.4, this is 10. So this will now become what? 4%. And if this is 4, then what the balancing figure left here? 10%. How did I get 10%? Because my overall cost of capital is dash 14. What's my overall cost of capital, guys? 14. And you all can just check that what is the amount of the debt? 4. So overall cost is 14. Amount of debt is 4. What do you think is the balance, beta? Can I say 10%? And that 10% is nothing but your equity. Come on, yes or no? Yes, sir. Now, if this is 10 and if this is 0.6, because ideally 0. Here, how do we calculate this? This into this will give you this part. But if this is 10 and if this is 0.6, can I calculate my new KE? Come on, yes or no? Yes. That's 10 divided by 0.6. That is 16.67. So has the KE increased? Under this approach, NOI approach, has the KE increased? But KE has increased in such a way that KO remains dash. KO remains constant. Now you only tell me, what do you think here it will come? Suppose this is 0.6. So this is 0.6 into 10. This is going to be what? 6. Can you please tell me what the balancing figure here? Come on. 8. And if this is 8, and if this is, for example, 0.4, can you please give me what is going to be this part of KE? 20%. That is 8 divided by 0.4. So that is 20%. So now has the KE increased? Come on, yes or no? Yes, sir. KE has increased. But, you know, it has increased in such a way that benefit of cheaper debt gets compensated by the rise in KE. And your KO is always going to be kept constant. Okay. So what do you think will be the market value of the company? Here the market value of company is also going to be what? It is also going to be constant. Okay. Are you all okay with these 3 approaches, guys? What is the first approach? Tell me. Net income approach. Second approach, traditional approach. Third approach, NOI approach. Are you all convinced by this? Sure, confident, hello? Okay. Now, approach we'll do later on. First, let us do some questions. Okay. I don't want you to sleep. Okay. First, let us do some questions. After that, we'll continue further. Okay. Now, let us start with illustration 1. See, what is given to you, just check. Rupa Limited's EBIT is what? 5 lakhs. The company has 10%, 20 lakh debentures, and the equity capitalization rate is nothing but what? 16%. We are required to calculate what is the market value of equity and what is the market value of the firm. Everyone, please tell me what will be the format of the income statement. First, we'll start with EBIT, guys. From EBIT, what will you subtract? Interest. You will be getting EBIT. Okay. Now, This EBT itself is your dividends. You are required to calculate market value of equity. How will you calculate market value of equity? Hello? I have dividend, come on, yes or no? Do I have capitalization rate, yes or no? So can I say I will take dividend and I'll capitalize that by 16%. So 3 lakh divided by 16%. What's the answer, guys? 18 lakh 75,000. Can I say this is nothing but KE? Value of the equity, come on, yes or no? Yes, sir. How do you calculate value of the firm? Whatever is your value of equity, to that you add what? Value of debt. Market value of equity plus market value of debt. Will that give you market value of the company? Come on, yes or no? Now, what is the debt amount? Your debt amount is what? 20 lakhs. So you add 20 lakhs to this. So this will be what? 38 lakhs 75,000. Superb. And then they've told you what is the overall cost of capital. So that is something which they have asked you to calculate Q. How do you calculate KO, guys? EBIT upon value of firm into 100. Do you have EBIT? How much is your EBIT, guys? Hello? 5 lakhs. Do you have value of the firm? Yes. You will be getting this as 12.90%. Superb. Everyone understood this? Okay. Now traditional approach. Let us do illustration 2. Indra has an EBIT of what? 1 lakh. The company makes use of both debt and equity. The firm has 10% debentures of 5 lakhs and firm's equity capitalization rate is 15%. You are required to calculate value of the firm and overall. This is the same thing. There is no need for any traditional approach here. Normal calculations will only go. Please tell me EBIT minus interest, what will you get? EBT. Can I say this EBT itself is nothing but your dividends? Now if I want to find out value of the firm, everyone please tell me what will be the formula? Can I say market value of equity plus market value of debt? That will give you total market value of the firm. Come on, yes or no? Yes, sir. How will you calculate value of equity? You will take your dividend and you will capitalization rate that by 15%. So what is the final answer, beta? 3,33,333. Is this the value of equity? Come on, yes or no? Yes, sir. What is the value of the debt? Your value of the debt is 5 lakhs. You add 5 lakhs to it. So you will be getting 8,33,333. Got it, everyone? Okay. Then they asked you, what is the overall cost of capital? Guys, do I have the EBIT available? How much is that? 1 lakh. Do you have the value of the firm available? How much is that? 8,33,000. So you take EBIT divide by value of the firm. You will be getting the final answer, which is 12%. Okay. Question number 3. Now determine the optimum capital structure of the company from the following. So now see, we have options given to you. We have cost of debt, we have cost of equity, and then we have percentage of debt on the total value. Okay. Now basically we have to find out the optimum capital structure. When I say optimal capital structure means the capital structure in which your KO should be dash. Maximum or minimum? Minimum. Your KO should be minimum. Okay. Now see, how will I do this? Guys, do you have KD? Yes. Do you have KE? Yes. And you also have the proportion. Okay. So can I put it like this? That if you have your option 1, you have your KD, you have your KE, you have weights of debt, you have weights of equity. So what will be your KO? Can I say KO will be nothing but weighted average? Hello? It will be weighted average. So we need to check whatever is your weights of debt into cost of debt plus whatever is your weights of equity into cost of equity. That will give you nothing but your KO. What we used to prepare in table, we used to do this only. From weights we used to multiply its cost and then we used to sum it up. We used to get nothing but your KO only. Come on, yes or no? Yes, sir. So here the same concept. What's your KD, everyone? 11. What's your KE? Come on fast. What's your KE? 13. What's your weights of debt in the first plan? So can I say entire thing is what? Weights of equity. So will this be nothing but 13%? Come on, yes or no? Yes, sir. In the second part, give me cost of debt. 11%. What's your cost of equity? What's your weights of debt? 0.1. Can you please give what's your weights of equity? Now how will you calculate your Q? So take 0.1 into 11, put that in memory, and take 13 and multiply that by 0.9, put that in memory, Press memory recollect. Will you be getting 12.8%? How much are you getting? 12.8%. Just confirm. Are you getting 12.8%? Solu yaar. Then similarly, we are going to calculate this for every part. And which structure will we select, beta? The structure in which your overall cost should be maximum or should be minimum? Minimum. So which structure has minimum? Can I say second part? 12.8%. Everyone understood this? Come on, yeah. Question number 4. Now here also, Amitas Limited EBIT is given to you as how much amount? 5 lakhs. The firm's cost of debt is given to you as what? 10%. And the currently the firm employs 15 lakhs of debt. The overall cost of capital of the firm is 15%. You are required to calculate what is the value of the firm. Now this is also the same thing, my dear students. See, do you have KO first of all? Overall cost of the firm. Do you have KO available? Come on, yaar. What's your KO? 15%. Now from EBIT, what do we subtract? Come on, interest. What do you get? EBT. EBT is also known as what? Dividends. What's your EBIT, guys? 5 lakhs. What's your amount of interest? 15 lakh, multiply that by 10%. 1 lakh 50. What's your dividend? 3 lakh 50. If I ask you what is the value of the firm, and if I have the KO available, can I say I can take EBIT and capitalize that by KO, yaar? Okay. So in that particular case, what is the value of the firm which I'm getting? 33,33,333. Right? What's the second part? Cost of equity. Now how will you calculate your cost of equity? See, to calculate cost of equity, what's the formula for K? Dividend upon market value of equity into 100. Are DPS upon MPS into 100. Or else if you take in totality, it is nothing but dividend upon market value of equity into 100. Come on, yaar. Is this the formula to calculate your KE? Come on, yes or no? Yes, sir. Now just check and tell me, in the income statement, do you have dividends? What we just prepared, do you have dividends? Come on. What is the amount of dividends? 3,50,000. But do I have market value of equity? No, I don't have, but I can find it out. What is the market value of the equity, beta? Whatever is the market value of company, from that if I subtract market value of debt, will I get market value of equity? Come on, yes or no? Yes, sir. What is the market value of the company, guys? The market value of the company is 33,33,333. What is the market value of debt? 15 lakhs. Now give me market value of equity. 18 lakhs. Multiply this by 100. You will be getting your key. What's your key? 3,50,000 divided by 18,33,333. 19.09%. Just check. Are you all getting the KE as 19.09%? Superb. Have you all understood this? Okay. Okay. Now let's do question number 5. Illustration 5. Alpha and beta are identical except for its capital structure. Alpha has 50% debt and 50% equity, whereas beta has 20% debt and 8% equity. All percentages are based on market value terms. The borrowing rate for both the companies is 8% in a no tax world. So borrowing rate is what? Nothing but what, beta? 8%. So your KD is nothing but 8%. And the capital markets are assumed to be perfect. If you own 2% of the shares in Alpha, determine your return if the company has net operating income of 3,60,000 and the overall capitalization rate of the company, which is given to you, that is KO, which is nothing but 18%. Okay. Now you have to calculate what is the return for an investor. Okay. And also calculate the implied rate of return on the shares of Alpha. Beta has the same net operating income as that of Alpha. You are also required to calculate your implied rate of return and why is it differing from Alpha Limited. First step is we have to prepare the income statement. Do you have EBIT which is given to you 3,60,000? So do you are 3,60,000. Okay. Now please tell me, what is your capitalization rate of the company? 18%. So now you will be getting your value of Alpha Limited, which is nothing but what? 20 lakhs. Now they have told you that if the value of Alpha is, how much was it? 20 lakhs. In that we need to check what is the proportion of debt and what's the proportion of equity. How much percentage debt have they told you in the question? 50%. So that is nothing but 10 lakhs of your debt and 10 lakhs of your equity. Okay. And they have told you that the borrowing rate is this, and also at the same time they have mentioned that if 2% of the shares of Alpha, if you own 2% of the shares of Alpha, determine your return if the company has the net operating income of 3,60,000. Please tell me, if you have 2% shares of Alpha, how much percent equity do you have? This is equity, this is debt, right? So total equity of Alpha is nothing but how much? What is the total equity of Alpha? What is the total equity of Alpha? 10 lakhs, but you are holding how much percent? 2%. Can you please give me what is your market value of holding? 10 lakh into 2%. Can you please tell me how much is that? 20,000. Okay, so this is your holding. Now, from EBIT, if I subtract interest, what do I get? EBT, which is also known as your dividends. Can you please tell me what is the rate of interest which they have given to you? 8%. So your EBIT was, how much was your EBIT, guys? Your EBIT was 3,60,000. So from 3,60,000, if I subtract now interest part, which is 10 lakhs into 8%, can I say this is 80,000? So what's my dividend, guys? 2,40,000. But you are holding how much percentage stake? 3,60,000 minus 80 is how much? 2,80,000. Sorry, this is 2,80,000. And you as an investor, you are holding how much percentage stake? 2%. So you multiply this by 2%. How much? 5,600. Now can you please give me what's your return? You are getting 5,600 and you invested how much? 20,000. Give me the percentage. How much is it? 28%. So you should all be getting this as 28%. Are you all getting this? Okay. So this is the return which you are generating, and the implied rate of return is nothing but 28%. Second part, the same you have to do it for beta. So beta has the total value of the company of 20 lakhs. Now, why do I say that the beta is this? Your beta is the same total value of the company? Because in question, they have told you now they are identical except the capital structure, where this is given to you, and everything else is going to be the same, and its capital markets are assumed to be perfect. So beta also has the same value. Come on, yes or no? Yes, sir. How much is that? 20 lakhs. Hello? 20 lakhs. Okay, but their proportion is different. What's their proportion? This is debt, this is equity. So from EBIT, if you subtract your interest, you'll be getting 3,28,000. Now, if you take 3,28,000 divided by 60 lakhs, what's your implied rate of return? 20.5. What was our implied rate? 28. What is this implied rate, which is 20.5? Now, why do you think that your return of alpha is better than beta? Now, that is because we have more debt in the capital structure. Just check. Alpha uses what? More debt in the capital structure. When you use more debt in the capital structure, now you enjoy the benefit of trading on equity also. You enjoy the benefit of tax savings on interest also. So apparently what happens is that the equity shareholders will get definitely more benefit. Come on, yes or no? Yes, sir. So that is why, if you guys can just check this out, you will come to know that implied rate of return on beta is lower than alpha, because beta uses less debt. Beta uses what, beta? Less debt in its capital structure, and as the equity capitalization rate is linear function of debt to equity ratio, when we use NOI approach, the decline in the equity return offsets the disadvantage of not employing benefit of the cheaper debts. So we are not going to get any benefit of a cheaper debt in this particular case. Okay. So this was your NOI approach. Are you all okay with this? Okay. Now we will be doing your approach. So now we are starting with your approach. Okay. Now this is something which you are going to do it with the help of your arbitrage. First 5 questions absolutely clear, guys. Okay. First 5 illustrations. Are you all fine? Okay with this much part? Okay. Now we are going to do something with regards to your arbitrage. approach. So I have done questions on illustrations which were given to you on net income approach, traditional approach, NOI approach. Now we are doing approach without tax, where there is what? Concept of arbitrage profits. Are you all ready? Okay. Now see, what is this approach? Without tax. Okay. Now see, what this approach tells you. This approach tells you that if there is an arbitrage opportunity, people will try to exploit that arbitrage opportunity. Now, what is the basic meaning of the word arbitrage opportunity? To buy from a place where it is cheap and to sell at a place where it is expensive to get something which is called as short profits. So let's say, for example, one commodity in Chennai is available at 20 rupees. The same commodity in Mumbai is available at 25 rupees. People will start buying from Chennai, sell where? Mumbai. Can I say definitely there will be some profits come on? Yes or no? Yes, sure profits. But what happens is when you start buying more and more from Chennai, the demand in Chennai is higher. So the price of the commodity will grow up. And when people will start selling in Mumbai, can I say the prices will go down? So then this 20 rupees will go up, 25 rupees will come down, and there will be a point of equilibrium. So same concept applies. That is, suppose there are two types of companies. One which is called as undervalued companies and one which is called as overvalued companies. People start buying which company shares? Underlying company shares. And they will start selling overvalued company shares. So when you buy undervalued company shares and when you sell overvalued company shares, can I say that at one point of time, the value of both the companies will be the same? So when value of both companies will be the same, can I say that the KO is also going to be the same? Because what is KO? EBIT upon value of the company into 100. So if both the companies are running same operating profits and both the companies have the same value, what do you think is going to be your KO? Can I say your KO is always going to remain what? It's going to remain constant. It's going to remain same. But it's a very unique way of explaining this. So he explains this entire concept with the help of what? Arbitrage scheme. Now he says that suppose there are two types of companies. One it is levered company, one it is unlevered company. Example. What is a levered company? A levered company is a company which takes dash in the capital structure, which takes debt in the capital structure. Unlevered company is only equity company. Okay. What is levered company which takes what in the capital structure? Tell me. It takes debt in the capital structure. And what is unlevered company, guys? It takes only equity in the capital structure. Now, this is debt and equity both. Okay. But it has debt in the capital structure. Suppose says that, for example, levered company has a value of, let's say, 20 lakhs. And an unlevered company has a value of what? 15 lakhs. Both the companies have the same EBIT. Both the companies have the same EBIT, 1 lakh, 1 lakh. Now, what does tells you in this particular case? That which one is the overvalued company? Tell me, levered or unlevered? Which is an overvalued company, levered or unlevered? Levered has a total value of 20 lakhs and unlevered company has a total value of 15 lakhs. Please tell me which company has a higher value? Levered or unlevered? Levered company is overvalued. So people will start selling which company shares? And people will start buying which company shares? Can I say for sure you will earn some arbitrage profits? And to earn this arbitrage profits, what does people do? They will start selling which company share, beta? Levered, so their value will fall. They will start buying which company shares, beta? Unlevered, their value will rise. And can I say there will be a point of equilibrium? And at point of equilibrium, will the value of both the companies be the same? Come on, yes or no? Yes, sir. So this entire concept we have to discuss. Okay. But first we have to identify which is a overvalued company and which is a undervalued company. People will start selling which company shares? Tell me. Overvalued. And they will start buying which company shares? Undervalued, for them to get some arbitrage profits. Now come to this illustration 6. There are two companies N and M. Okay, so there are two companies there is N, there is M. Having the same EBIT of 20,000. So do you have the EBIT, guys? Yes, sir. 20,000, 20,000. Okay. And then what have I told you? That M is a levered company. So M is a levered company. N is an unlevered company. And M has a debt of rupees 1 lakh at 7% rate of interest. From EBIT, what do you subtract? Come on, yaar. What do you get? EBIT. And this EBIT will be called as your what? Dividends. Right? Now in this particular case, let's talk about interest. Can I say for levered company, what is the amount of loan which you have? 1 lakh, and what's the rate? 7%. So 1 lakh into 7%. Can you please give me this? What is the amount? 7,000. So what's your interest? 13,000. For unlevered company, is there any interest? No. So this has to be what? 20,000. Are you all convinced by this much part? Okay. Now, my dear students, we have the cost of equity of N limited, which is 10%. N. What's the K given to you? 10%. What is your K available for M limited? Tell me. 11.5%. Compute how the arbitrage process will be carried on. Okay. Now tell me one thing. What is the market value of equity for N limited? How will you calculate market value of equity? You all have to answer. Come on. How will you calculate market value of equity? Can I say I will take dividend? Very good. Upon what? KE. What's my dividend, guys? 20,000. Divide that by KE. Can I say this will become what? 2 lakhs. Here it is going to be 13,000, which I'll capitalize by 11.5%. Give me this. 13,000 divided by 11.5%. 1 lakh. 13,000. 043. Have I got market value of equity? To this market value of equity, what will I do? Market value of debt. Can you give me unlevered company? Is there any debt in the capital structure? And then here, what will be the debt? 1 lakh. Shall give me what is this going to be? 2 lakhs. 2 lakh 13,043. Now tell me which company has a higher market value, M or N? Which company has a higher market value, M or N? M has a higher market value as compared to N. Come on, yaar. So M has a higher market value as compared to your N. So can I put it like this? कि भाई ये जो levered company है ना, this has a higher market value. So this is an overvalued company, and this is what? Undervalued company. What do you think you should do? You should start selling which company shares? M. And you should start buying which company shares? N. Okay. So assume Mr. X, an investor in N limited. M. Overvalued companies is M. So first let us assume Mr. X is an investor in M limited. Which company is just overvalued? So he is an investor in overvalued company at the rate of 10%. So he is an investor at what percentage rate, guys? 12%, 10% rate. So if he's going to sell this, what is going to be the sales proceeds which will be generated? Okay, if he sells 10% stake, okay, if he sells the 10% stake, can I say that what is the market value of equity, guys? What is the market value of equity, everyone? 1,13,043. Now, if he is going to sell 10% of his stake, is he going to get entire 1,13,043? Or will he get 11,304? 11,304, which is nothing but the 10% of market value of equity. Come on, yaar. Okay. Now, this is the amount which is available. So, has an investor sold shares of M Limited? Come on, yes or no? Come on. And they have sold the shares. So, how much money he has received? 11,304. Now, what should he do? He should buy shares of N Limited. Okay, which is an undervalued company. But N Limited does not have any debt in the capital structure. So that is why to maintain the same level of risk, what did I just say? To maintain same level of risk, what Mr. X is supposed to do? So X will borrow. What X is going to do? borrow. X is going to borrow. So now in what proportion should X borrow? So in the same proportion of whatever was the debt equity of N limited. So for M limited, you all just check what was the debt? 1 lakh. And what was the equity? 1,13,043. Now he has sold 10% shares. So he has got 11,304. So what should be the amount of debt? You cross multiply, you will be getting this as 10,000. So this is the amount of borrowings which you have got. Okay. So X will borrow 10,000, and that also at what rate of interest? So at the same rate of interest, which is going to be what? 7%. Are you all okay with this? Okay. Now please tell me, what are you going to do? We'll be taking EBIT. From this, what do you subtract? What do you get? Okay. Okay, we have already done that, but wait. 10,000 at 7%. He is going to take it. Okay. Now, can you please tell me what's the total proceeds which he has? What is the total proceeds which he has? Can I say 11,304 he has? Plus how much amount he has here? 10,000. So can you please tell me how much amount does he have? 21,304. Now what do you think he should do with this 21,304? Can I say he can invest in N Limited, which is an undervalued company. So now we will write down what? Buy shares of N Limited. We'll tell him to buy the shares of N Limited. Now when he will buy the shares of N Limited, he will become the shareholder of which company? N Limited. So can I say if he becomes the shareholder of N Limited, will he get some dividends from N? Solo yaar. Yes sir, he is going to get some dividends from N. But how much dividends is he going to receive? So just check. What was the total dividends, guys? 20,000. Will he receive entire 20,000? Will he receive entire 20,000? That 20,000 was when the market value of equity was 2 lakhs. So if you are buying entire 2 lakh shares, you get 20,000. But are you buying entire 2 lakh shares or you are just buying 21,304? 21,304. So can you please tell me 21,304 into 20,000, divide that by 2 lakhs. Can you give me the answer? How much is this coming as? 21,2130.4. This is the dividend an investor is receiving from which company? N. But don't you think that he has taken some loans? Come on, yes or no? If he has taken some loans, then what he has to pay? Interest. So he has to pay interest. How much loan has he taken? 10,000. What's the rate of interest? So can you please tell me what is going to be your interest? 700. But also we have to subtract what is the dividend lost from M Limited. Because earlier we were stakeholders in which company? Earlier we were stakeholders in which company? M Limited. How much percentage stake we had? 10%. So can I say that we had 10% stake, so we were earning dividend of, or were we earning dividend of entire 13,000? We had all the shares or we had only 10% of the shares? So can I say our old stake was 10%. So how much is this what we are getting? 1,300. Come on, yaar. So now please tell me, is there any arbitrage gain possibility or not? How much is that? 130. So this is your arbitrage gain. And people to exploit the arbitrage gain, what they will do? They will start buying undervalued company shares and they'll start selling overvalued company shares. Can I say there will be a point of equilibrium later on? Come on, yes or no? Yes, sir. Convinced? So this is the entire steps which you have to follow in your arbitrage process under MM approach. Okay. Now, my dear students, what's the next part? Okay. So this is what alternative strategy 1300 and all those things what we calculated is given to you here. Okay. Now illustration 7. Now what is illustration 7, guys? In illustration 7, you will see that which company has a higher market value. So you will see now your unlevered company has a higher market value. So you should sell your stake from unlevered company and invest where? Levered company. For sure you earn some arbitrage profits. Okay. Now just check this out here. Illustration 7. Okay. Now see what is given to you. How do we start, beta? Income statement. Yes or no? Okay, so there are two companies. What are the two companies, beta? Levered, unlevered. Okay. Now what is given? You just check. You have capital employed 2 lakhs. EBIT is what? 30,000. K is 12.5%. Oh no, this is normal only. This is from levered to unlevered company. Oh, this is the exactly what we did earlier. The same part is getting repeated. I think in the next question there is change. Unlevered company is more than levered. Okay. So this is normal question only. What we just now did. What did we just now do? Can I say we shifted from dash to dash? Can I say we shifted from levered to unlevered? See, just check what is your K which is given to you. 12.5%. Now see, how will we come to know? Just check what is the value of equity for levered company. See, this is the income statement. Your dividend is nothing but what? 20,000. Once we capitalize it at 12.5%, it is 1,60,000. So don't go by this book values. Huh? Do we have to go by book values or do we have to go by market values? Market values. So that is why we calculated your value of equity. It came as 1,60,000. This is 1 lakh. This is 2,60,000. This is 2,40,000. Don't you think 2,60,000 is greater than 2,40,000? Come on, yaar. So which company has a higher market value, levered or unlevered? And you have to be an investor in which company? Levered. Sell your stake and invest where? Unlevered. For sure you will earn profits. In our example, I just assumed the investor stake to be what? 10%. Just check here. The investor stake is given to you as what? 15%. Follow the same steps, you will be getting the answer. Okay. So this is your question number 7. Now I am doing question number 8. Now what is your question number 8? Question number 8 is nothing but we are shifting from dash to dash. Unlevered to levered. Okay. Now we are shifting from unlevered to levered. Okay. Question number 8. Let's do this. See, now what is going to do? There are two companies. Okay, so question number 7 was very similar to what we have done in illustration 6. Solu yaar. So this was nothing but your levered to unlevered. Now illustration 7 and 6 were same. Now we are doing illustration what? 8. Now you know from where are we shifting where? We are shifting from unlevered to levered. We are shifting from unlevered to levered. Okay. Just check this out. There are two companies U and L having the same NOI. NOI stands for your net operating income, which is nothing but what? 20,000. Except that L is a levered company having a debt of 1 lakh at 7% and cost of equity of U and L is 10 and 18. We are required to calculate how the arbitrage profits will work. Okay. Chalo. Everyone please tell me. Unlevered company, levered company. How do you start? EBIT minus what? What do you get? EBT also known as your what? Dividends. What's your amount of net operating income? Solu, come on, yaar. 20,000. Is that your EBIT? Okay. Please tell me what's the amount of the debt? 1 lakh. What's the rate? So 1 lakh into 7%. What's your interest? What's your dividend? 13,000. Here there is no interest. This has to be 20. Are you convinced? Okay. Now what's your KE? Let's check your KE. What's your KE? Your KE for U is what? 10%. What's your KE for L? 18%. Can I get market value of equity? Chalo fast. What's the market value of equity? This is 2 lakhs. You take 13,000, you divide that by 18%. This is 72,222. What's the market value of debt? For unlevered company, it's 0. For market value of debt, this is 1 lakh. Can you please tell me now the total market value of the company is 2 lakh and 1,72,222. Now which company has a higher market value? Unlevered. So we are what? Overvalued companies and this is what? Undervalued. What should you do? What should you do? You should sell. You should go from dash to dash. You should go from unlevered to levered. For sure, will you make profits? Yes. So now let us assume Mr. X has how much percentage stake? 10% stake. In which company? In unlevered company. So therefore, what is going to be the sales proceeds? Can you please tell me what's going to be the sales proceeds? 2 lakhs into 10%. What is this amount going to be? Can I say this will be 20,000? Solu yaar. You are going to receive sales proceeds of rupees 20,000. Okay. Now, What are you going to do with the same? We are going to invest it. Where to invest? Invest in levered. Levered company, does it have debt and equity both in the capital structure? So in this particular case, invest in L and in debt also and in equity also. But in what proportion? In the same proportion. This was 1 lakh. This was 72,222. Matlab total was 172,222. How much amount do we have? 20. So now this 20,000, divide that by 1 lakh 72,000 to 1 lakh 72,222, and then multiply that by 72,222. You will be getting this as 8387. This much you have to invest in equity. Are you all getting this? And from 20,000, if I subtract 8387, so how much amount I have to invest in debt? 11,613. And if you invest in debt, what will you get? Interest. So we will invest in debt and equity. In that case, we were taking loan and investing. Your amount which we have, we are investing that in debt and equity. Are you understanding this? Okay. Now, what is the rate of interest which you are going to get? 7%. Now, what is going to be your interest income from levered company? So that is 7% of 11,613. Can you give me this? 812.91. What is your dividend income which you are going to get from levered company? So the dividend income which you are going to get, that will be on the 8387 which you have invested, right? So they are giving you dividend which is 13,000 when you have invested 72,222. So if you would have invested 72,222, you would have got 13,000. But how much you have invested? 8387. How much will be this? 8387 into 13,000, divide that by 72,222. So this will be coming as how much amount? 1509.6. Okay. How much is the total amount which you are getting? How much is the total amount which you are getting? If you just check this, you are going to get 2322.57. Now, where were you earlier? In levered or unlevered? Unlevered. So, what is your dividend lost from unlevered company? So, in unlevered company, how much dividend was given? 20,000. At you are having 10% stake. So, 20,000 into 10%. How much dividend are you losing? 2,000. So, what's your arbitrage gain? 323. This is your arbitrage gain. So, I have taught you both the methods. Okay, if it is levered to unlevered, what you have to do? And if it is unlevered to levered, what you have to do? You just have to follow all the steps. Okay? Are solo yaar? Okay. See, alternative, we can also invest in the entire amount, and that's what we have done. That is something which is given to you. Okay. And question number 10 now. Now this is very simple. Question number 9 is very similar to question number 8. Here now they have given to you how much percentage stake does an investor have? 50% stake. So can I say it's the same part which will be repeated? Come on, yes or no? Yes, sir. So the same part which will be repeated, but now an investor is holding how much percentage stake? 15% stake. So that was 10%. This is how much? 50%. And that's how we have to solve it. Okay. Now let us do illustration 10. Now this is your with tax. Okay. Okay, so this is, I think, the last illustration. After that we are, no, then there are illustrations pertaining to EPA, EBIT, EPS. Okay. But this won't take much of your time. This will be able to understand it very thoroughly. Okay, because this is relatively easy. Okay. But I'll not stretch much today, don't worry. Okay. I can see it from your faces. Right? Because I think, because this capital structure theory is little bit of heavy also. Don't worry, we will do that EBIT, EPS, etc. part we'll do it from tomorrow. Okay. Tomorrow 1.5 hours I'll take for EBIT, EPS and all the other practical questions. Don't worry. But at least whatever you are doing, you have to focus properly. You have to pay attention. Are you there? Sure. Are you all tired? Should I? order coffee for you. You want coffee in 50 rupees? You want coffee? No. This maroon shirt is not denying also. It's like you want to order, you order. It's okay. Chalo, we'll complete this and then we'll go, okay? Then we'll do your EBIT, EPS and all the other things. But promise me that you are going to revise this, you'll solve this and come tomorrow. At least question number 1 to 10. Will you do that? Can I trust you? Because investment decision is also very lengthy. In that we'll be doing some selective part, not everything. Okay, because it's very lengthy. If I do everything, then I will need 4-5 days just to complete investment decision. Okay, so all the important parts will do it. Because the questions itself, they are very lengthy. Very lengthy to solve. So every method, one question will revise for investment decision. Okay. It's not possible to revise the entire investment decision. You just check what are the number of illustrations which they have in the book. Just check. Anyone who has the book, just check investment decisions. 18-20 illustrations are there. And then practical problems also are massive. 14 around. So 30-35 questions is not possible to revise. So that we'll try as much as possible, covering all the methods and all the types. But at least this is something which I wanted all to do it. Okay. But are you guys understanding? Okay. Sure, confident. Okay. Question number 10. Let's do this. Now this is MM with tax. What is this, guys? This is your nothing but MM with tax. Now pay attention. MM with tax. Now my dear students, please tell me. First approach, what did we do? NI approach. Second, what did we do? Traditional. Third, NOI approach. Fourth, MM approach without tax. Last approach, what is it? MM approach with tax. Now you must be wondering, sir, what is this MM approach with tax? So when there is tax rate which is given to now, always remember that a company in which there is tax savings now, that company will have a higher market value as compared to the company in which there is no tax savings. So which company will have a higher market value, beta? The company in which there is going to be tax savings. So between levered company and unlevered company, can you all please tell me which company has a higher value as compared to the other? Levered will have a higher market value or unlevered will have a higher market value? Levered or unlevered? Of course, levered will have a higher market value as compared to the unlevered, yaar. Because levered enjoys what? Tax savings that unlevered is not going to enjoy. So that is why MM says that market value of levered company should always be market value of unlevered company plus debt into tax. Are you guys trying to understand what's the formula, beta? What is the formula for market value of levered company? Market value of unlevered company plus what? Debt into tax rate. That will actually give you dash. What it will give you? That will give you your market value of firm. That is market value of the levered company. Which is market value of unlevered company plus what? Debt into tax rate. Are you guys first understanding what is the question? Okay, that market value of levered company is what? Market value of unlevered company plus what? Debt into tax rate. Now, this debt into tax rate deals with what? It deals with your tax savings on interest till perpetuity. Okay, so that is the meaning of this. That is tax savings on interest till perpetuity. Okay. Now just check what is this question. Blue Limited is an all equity finance company and is considering the repurchase of 275 lakhs of equity shares and to replace it with 15% debentures of the same amount. Please tell me first, this particular company was levered company or it was unlevered company? Blue Limited was an all equity finance company. So can you please tell me, was it a levered company or it was an unlevered company? It was unlevered. What the company is trying to do? They want to repurchase equity shares and they want to replace it with debt. So now this unlevered company wants to get itself converted into dash. Levered company. Please tell me, Blue Limited will have a higher market value under which situation, beta? Can I say levered or unlevered? Can I say once they will turn into levered company, they will have a higher market value? Come on, yes or no? Yes, they will have a higher market value. And then current market value of the company is what? 1750 lakhs. So can I say this is nothing but market value of unlevered company? At present, what is the value? 1750. What is the cost of capital which is given to you? So that is nothing but 20%. EBIT are expected to remain constant in future years, and the company has a policy of distributing its entire earnings by the way of dividends. Assuming that the corporate tax rate is 30%, you are required to calculate the impact of the following on the account of the change in the capital structure. First is your market value of the company, overall cost of capital, and cost of equity. See, first, please tell me, guys, we had market value of unlevered company. How much was that? 1750. And they have told you that what was the cost of capital, beta? 20%. So can I say that if the company was unlevered company, this entire thing is nothing but market value of equity? Come on here. This entire thing is market value of equity because there is no debt. And if this is 20% KO, can I say that is nothing but your KE is 20%? Now if you take 1750 and multiply that by 20%, will I get your dividends? What will be your dividends, everyone? How much? 350. Now please tell me, EBIT minus interest, what do you get? EBT. Minus tax, tell me what you get? NPAT. Now have I got my NPAT which came as how much? 350 lakhs. Okay, so what did I do? I simply took my market value of equity and multiplied that by 20%. So whatever was our market value of equity, if you multiply that by 20%, what will you eventually get? Dividends. So I've got my dividends, which is amounting to what? Nothing but 350. Now if I've got my dividends, which is 350, can I say I can go reverse and I can calculate my dash? EBIT. What's the tax rate, guys? What's the tax rate? 30%. So 130, this will be 70. Can you give me what is going to be your EBT, guys? 500. There is no interest. EBIT is 500. But now we are converting from dash to dash. Unlevered to levered. So can I say my levered will have EBIT of 500? What is going to be my interest part? Can I say my interest is going to be, what is my interest going to be? Can I say 275 lakhs into 15%? So what is 275 lakhs into 15%? Can you give me this interest? Sorry? 41.25. What is your EBT? 500 minus 41.25. 8.75. What's the tax rate? 30%. 137.62. Can you give me NPAT? .125. So this is the net profit available for equity shareholders after the company becomes levered company. 321.125. Okay. What have they asked you? What is the market value of the company after restructuring? After restructuring means after taking debt in the capital structure. Can you give me market value of the company, everyone? What is market value of the company, boss? Can I say that is nothing but market value of equity plus market value of debt? But this is not the formula which we are going to use. Because whenever there is tax rate given to you, what did I just say? Whenever there is tax rate given to you, can I say your market value of levered company will become market value of unlevered company plus debt into tax? What is the market value of unlevered company? What was the market value? 1750. What is your debt? How much is it? 275. What's the tax rate? 30%. Can I get this 1150 plus 275 to 30%? What is this going to come? 1,832.5 lakhs. Just check this. This will be 1,832.5 lakhs. Understood this? Okay. This is market value of the firm. But second is what is the overall cost of capital. But before that, we already need your KE. So first should I find out KO or first should I find out KE? KE should be first found out. Because once I have KE only, then I can calculate my KO. How will you calculate KE, guys? Can I say KE can be calculated by taking whatever is your dividend upon market value of equity into 100? This is the formula for your KE. Come on, yes or no? Yes, sir. Just check what is going to be your dividends. So my dear students, your dividends after you are doing capital restructuring, what is the dividends which you have? After you're doing capital restructuring, what is the dividends which you have? Your dividend is 321.12 lakhs. So can I say I can take 321.12 lakhs and I can divide that with what? Whatever is your market value of equity to get your KE. Because I want to first find out my KE. So what is my KE? Market value of firm minus market value of debt. What was the market value of firm? 1832.5. What was your debt? 275. Can you please give me what's your market value of equity? 1,557.5. Can you please give me what's your KE now? Because it's dividend upon market value of equity into 100. So what's your KE? 321.12 divided by 1557.5 into 100. Sorry? 20.62%. This is your KE. Just check. Your KE should be coming as 20.62%. And then how will you calculate overall value of the firm? We have equity, we have debt, we have the amounts available. So this is the amounts. So this will be the weights. Ultimately, this will be your overall cost of capital, which will be 19.11%. So this is what you have to do it. This is how you have to calculate it. So you will be getting the KO, which is nothing but 19.11%. Have you all understood this? Okay. So yeah, this is your final answer and that's how we have to solve it. Okay. Now we will put an end to today's lecture here only. This EBIT, EPS relationships and all those things will be starting from tomorrow. So question number 12 onwards, 12, 13, 14, all these are very good questions, illustrations. We'll be doing that tomorrow. Then we will do the practical problems. But have you all understood this illustration 1 to 10? So do one thing. If you want not, just do that levered to unlevered company, that 15% part, and unlevered to levered, that 15% part once again. So try to do that once again. Okay? So you should be able to get it. So that's it, my dear students. I'll see you tomorrow. Okay? At 10:30, we'll continue then. Okay? Bye guys. Take care. See you. Bye. Okay. Everyone, welcome back. Chalo. Are we all ready? Okay. So let's continue this further. Now, what are we going to continue with? So as you all are aware that we are going to continue this now with your capital structure. In the last lecture, we completed up to your EBIT. We completed up to your, what was the last thing which we did was your capital structure theories, right? So we also completed your approach till then. Okay. Now we are going to continue further with your capital structure, and we are going to continue now with something which is called as your optimum capital structure. Okay. Now, as I told you that what is the basic objective of a CFO for any particular company? That is nothing but to maximize what? Wealth of equity shareholders. So you will be definitely having, different types of financial plans, and we have to select the best financial plan in which what should be maximum beta. then can I say we have to select the proposal in which what should be maximum? The EPS should be maximum. Okay. And if the P ratio is given to you, then what should be maximum, beta? Your market price per share should be maximum. Are you able to recollect this? Okay. So now in this next particular optimum capital structure, we are going to do the relationship of what? EBIT, EPS and MPS. Okay. So now let us do this illustration level to understand this in much better way. Okay. See what is given to you. Let us check this out. Suppose that a firm has an all equity capital structure consisting of 1 lakh ordinary share of rupees 10 each. Okay. So basically the firm or the company already has some number of equity shares, and how much number of equity shares we have? 1 lakh shares. The firm wants to raise rupees 2,50,000 to finance its investment and is considering 3 alternative methods. Now, how much amount do you need, beta? 2,50,000 you need it. And if you need 2,50,000, how many plans do you have? We have 3 plans. First, to issue 25,000 ordinary share of rupees 10 each. So in the first proposal, we will be issuing entirely your ordinary equity shares. Second, it is what? That we are going to borrow 2,50,000 at the rate of 8%. And third part is what? That we are going to issue preference shares at rupees 100 each at 8%. Okay. So these are the 3 plans. If the firm's EBIT on additional investment is 3,12,500, the tax rate is 50%. Find out what is the EPS under the 3 alternatives. So it's a very basic question. How should you approach such kind of a question? Whenever you see a question on capital structure where you need 2,50,000 rupees, okay, and these are the 3 multiple plans. So the first thing is we have to prepare what is the summary of financial plans. What do we have to do, beta? We have to start with what is the summary of financial plans. How many plans do you have, beta? 3 plans do we have, and we are raising the money by the way of equity or debt or preference shares. Okay. What's the total amount which is required? Just check. The total amount which is required is nothing but how much, beta? 2,50,000. So we need 2,50,000. Okay. We need this 2,50,000 which is required. And in plan 1, just check how are we raising this 2,50,000. So we are issuing 25,000 ordinary shares of rupees 10 each. So entire money is your plan 1 equity share capital. There is no debt, there is no preference shares. In your second plan, you all can just check. We are going to borrow 2,50,000 at what percentage rate? 8% rate. So we are going to raise your entire 2,50,000 with the help of 8% rate. And then in the third part, there is issue of 2,500 equity shares of rupees 100 each at 8% preference dividend. So are we raising by 2,50,000 by the way of preference share capital? Come on, yes or no? Yes, sir. So once you prepare the summary of financial plans, then we have to check what are the number of equity shares. Okay. Now this number of equity shares, this will be having your existing number of equity shares and also some fresh issue of equity shares. Can I say this will give you your total number of equity shares? Come on, yes or no? Yes, sir. Can you please tell me what is the existing number of equity shares which we already have? So they have told you that we have 1 lakh ordinary shares. Ordinary always means your equity shares. So we already have existing 1 lakh shares. Now 1 lakh shares is going to be there irrespective of the way we are going to finance your capital. Can I say 1 lakh rupees is definitely going to be there? Come on, yes or no? Yes, sir. Now let us talk about your new plan. So in new plan, can I say in plan 1, we are raising 2,50,000. Come on, yes or no? Yes, sir. How are we raising this 2,50,000? Then in that particular case, we are raising this 2,50,000 by issuing ordinary shares of 25,000. So here the new shares will be 25,000. So can I say the total amount is going to be what? 1,25,000 shares. Please tell me for plan 2, will there be any new equity shares which will be issued? No, because the entire money is raised by the way of what? Debt. So this is entirely 1 lakh shares. In plan 3, are we raising the money by the way of issue of equity shares? No. So can I say this 1 lakh will be nothing but your total number of equity shares? Okay. Now, how do we have to start with this particular question? So we have to prepare what? Your income statement. Your income statement will always start in capital structure from which particular part? EBIT. See, in ratio analysis, we started with the income statement by sales, less COGS, less GP, less operating expenses that give you operating profits.
Okay, that was your EBIT. In leverages, we prepared the income statement starting with sales, less variable cost. We got contribution, less fixed cost. Then we got the EBIT. Here in capital structure, we'll always start with what, beta? We are going to start with your EBIT. From EBIT, what do you subtract, guys? Interest. What do you get, everyone? EBT. From EBT, what do you subtract? Tax. What is the tax rate which is given to you in the question? Is there any tax rate which is given to you in the question? They have told you that the tax is nothing but at the rate of 50%. Then what will you get next? Please tell me. Net profits after tax. From this, what will you subtract? Preference dividend. So ultimately, what will you get, beta? Net profit for equity shareholders, which will divide that with what, beta? Number of equity shares. What will we eventually get, beta? Can I say EPS? Is this the format of the income statement which we are going to prepare? Come on, yes or no? Yes, sir. How many plans do we have? We have 3 plans. Okay. Now, in these 3 plans, let us first start with the amount of EBIT. So, is the amount of EBIT which they have given to you in the question? Come on, yes or no? Yes. So, that is nothing but what? 3,12,500. So, this is the amount of EBIT which we have. Now, from EBIT, what do you have to subtract? Tell me. Interest. Does plan 1 have any interest? No. So, can I say your EBIT will itself will become 3,12,500. Okay. Then we have to subtract tax, NPAT, preference dividend, net profit for equity shareholders. We divide that by number of equity shares. Ultimately, we get the EPS. Can I say the same happens with plan 2? But will plan 2 have any interest? Come on, yes or no? Yes, sir. What will be the amount of the interest, guys? Can I say from 2,50,000, then we have to subtract what is going to be the interest. So that will be what? Your 20,000 rupees, that will be your interest. Come on, yes or no? Yes, sir. And then there is no interest here. But will there be any interest of preference dividend which will be coming in your plan 3? Come on, yes or no? Yes. And all these things we are going to divide this by the number of equity shares which we have calculated. So ultimately we'll be getting your EPS, and we will select the plan in which the EPS should be maximum or it should be minimum, beta. Maximum. So can you see here, in case of that your EPS is maximum, will we go forward with the same? Come on, yes or no? Yes, sir. Okay. Now after this, just come to the next particular part in which we are going to deal with your indifference point, etc. So come to your question number, illustration number 12. Now in this illustration 12, see what is given to you in the question, that best of luck, a profit making company has a paid up capital of what? 100 lakhs consisting of 10 lakhs ordinary share of rupees 10 each. So already, is there any existing number of equity shares which is there in the question? Come on, yes or no? Yes, sir. Okay. And currently it's earning a pre-tax profit of rupees 60 lakhs. Now please tell me, was there any debt in the capital structure? In the existing part, was there any debt in the capital structure? No. So can I say that entire pre-tax profit is nothing but your what? EBIT. So at present you are earning an EBIT of what? 60 lakhs. Now the company shares are listed and are quoted in the range of 50 to 80. And the management wants to diversify the production as an approved project which will cost 50 lakhs. So how much funds is required to be raised, beta? 50 lakhs is required to be raised, which is expected to yield a pre-tax income of 40 lakhs. Now always remember that whenever we are yet to structure your capital, so whatever is the profits which is getting generated from that project, that profits will always be called as your EBIT. That how much is the profits which we are going to generate from that additional project. Okay. And that is always before your structuring of your capital. So if I'm going to invest 50 lakh rupees in this project, how much amount am I going to earn out of that? 40 lakhs. So can you please tell me now, after expansion, what's the total EBIT which you are going to earn, beta? 100 lakhs. Okay. So this is going to be your EBIT after expansion. And then they have told you that to raise the additional capital, following options are there. How many options are there, guys? 3 options. So to issue your share capital for an entire additional amount, and it is expected that the new shares which is having a face value of 10 will be sold at a premium of rupees 15. Everyone please tell me, face value is what? 10. What's the premium part, beta? 15. So can you all please answer this in one voice and tell me what is going to be the issue price of the preference shares, of the equity shares? What's going to be the issue price? Can I say your issue price is going to be now 25 rupees? So now if I want to raise 50 lakh rupees and the issue price is 25, can I get the total number of equity shares which can be issued? Come on, yes or no? Yes, sir. So you will take 50 lakhs and you will divide that with what, beta? You will divide that by 25. Ultimately, you will be getting how many number of shares? 2 lakh shares. So can I say 2 lakh shares will be issued fresh? Come on, yes or no? Yes, sir. And to issue 16% non-convertible debentures of rupees 100 each for the entire amount. In the second plan, how are we issuing, beta? We are issuing entirely by the way of what? Non-convertible debentures. And to issue equity capital for rupees 25 lakhs, face value of rupees 10, and 16% non-convertible debentures. In this case, the company can issue the shares at a premium of what? Rupees 40. So can you please tell me what will be the issue price in the next case, beta? Can I say that will be 50 rupees? Come on, yes or no? Yes, sir. And advise which is the best option, and management wants to maximize the EPS, and the tax rate is what? 50%. What did I tell you? Whenever you see a question on capital structure, how should you approach that, beta? Can I say we can approach that by preparing the summary of financial plans? Okay. So what's the first step? How will you start with this particular question? You will start with what? Tell me. How will you start with, beta? Summary of what? Financial plans. Come on, yaar. Okay. And how many plans do you have? We have 3 plans with you. Okay. Now in the first plan, how are we raising the entire money? Can you please tell me? Equity share capital. In the second plan, how are we raising the entire money? 16% non-convertible debentures. Okay. Can I say this will give you a total amount? Come on, yes or no? Yes, sir. Please give me what's the total amount which is required to be raised. How much amount is required to be raised? Come on. 50 lakhs is required to be raised. Okay. And in first plan, we are raising the entire 50 lakhs by the way of equity. In the second plan, we are raising the entire 50 lakhs by the way of non-convertible debentures. And in the third plan, just check, we are issuing 25 lakh rupees equity and 25 lakh rupees by the way of debt. Okay. And then we should always write down what is the number of equity shares. Shri, can I say number of equity shares will be nothing but your existing number of equity shares plus whatever is your fresh issue, new shares. Can I say this will give me my total? Come on, yes or no? Yes, sir. So now what is the existing number of equity shares? Just check. What's the existing number of equity shares? Can I say we already have 10 lakh ordinary shares? So 10 lakh is my existing number of equity shares, which will come in all the 3 plans because it's an existing company and we already have some number of equity shares. So 10 lakh is going to be your existing number of equity shares for all the 3 financial plans. Okay. But when I'm talking about your fresh issue, so for your fresh issue, you need to check your plan 1. How are we raising this? So as we have discussed, the issue price is what? 25. So in this particular case, 2 lakh shares will be issued. Come on, yes or no? Yes, sir. So now from 10 lakh, if I add 2 lakh, what's going to be my total amount? 12 lakhs. Similarly, for your plan 2, you all can just check, is there any fresh issue which is going to be there? No. So this will be nothing but 10 lakh rupees. And for my plan 3, will there be any further fresh issue? Come on, yes or no? Yes, sir. But make sure what is the issue price for your plan 3? 50 rupees. So in that particular case, if I take 25 and if I divide that by 50 rupees, what will be the number of equity shares? Can I say 50,000? This is nothing but 0.5. So this will be now total 10.5 lakh shares. Okay. And then what's the starting point, beta? EBIT. EBIT, how much have I discussed? 100 lakh rupees, right? And then from EBIT, what do you have to subtract? Interest. Company does not have any existing interest. Only your new interest will come in plan 2 and plan 3. There will be EBT. You subtract tax. What do you get, guys? Come on, what do you get? NPAT. From NPAT, what do you subtract? Preference dividend. But is there any preference dividend in the question? So all the profits belongs to whom? It belongs to your equity shareholders. With this, we divide it with what, beta? Number of equity shares. What do you eventually get? EPS. Are you guys trying to understand? And once we are going to get the EPS, we have to select the plan in which your EPS should be minimum or maximum. Maximum. So this is the approach of the question which we have to take it into consideration. Okay. Continuing further, now after your question number 12, come to your question number 13. Now see what is given to you in your question number 13. Let's read this. That Shahaji Steel Limited requires rupees 25 lakhs for a new plant. Is this statement sufficient for you to understand that we are raising this funds by the issue of your, we are going to require rupees 25 lakhs. So which means that we have to structure your capital. Come on, yes or no? Yes, sir. Now this plant is expected to earn an EBIT of how much? 5 lakhs. Now while deciding about the financial plan, the company considers the objective of maximizing your earning per share, which we already know. Okay. And how many alternatives are there, beta? There are 3 alternatives. So by raising debt of 2 lakh 50 or 10 lakh or 15 lakh, and balance is by issue of equity shares. So as I told you, what's the first step, beta? How will you start? Summary of financial plans. Now when I'm talking about summary of financial plans, how many plans do I have, beta? I have 3 plans. Come on, yaar, yes or no? I have 3 plans, and in this 3 plans, I am raising it either by debt, matlab I am raising in the combination of what? Debt and equity. Can you please tell me what's the total amount which is required? What's the total amount which is required? It is 25 lakhs, right? Now this 25 lakh rupees which I require has the combination of debt and equity both. Now in the first plan, what is the amount of debt which you are taking, beta? So can I say this is 2 lakh 50? Come on, yaar. So what is going to be your equity, beta? 22 lakh 50. Okay, in your second plan, what is the amount of the debt, beta? 10 lakhs. Hello. What is going to be your amount of equity, beta? 15 lakhs. In the third case, what's the amount of the debt, beta? Can I say it is going to be 15 lakhs? So what is going to be your amount of equity, everyone? 10 lakhs. Are you guys trying to understand this? Okay. So with this, your plan 1, plan 2 and plan 3 will be over. We have debt, we have equity, and this is nothing but the total amount which we are required to raise. Now with this, can I say there is going to be some number of equity shares? Now in this number of equity shares, have they given to you any existing number of equity shares of the company till now? Then the answer is no. So there is no existing number of equity shares. So there definitely there is only and only going to be what? Your new equity shares. And for your new equity shares, you all need to check that how are we raising this new equity shares. So in this particular case, in your first case, we are issuing the new equity shares which is selling at what price? Rupees 150. So please tell me what is going to be the number of equity shares? Whatever is the fresh issue, divide that by issue price. So what's my fresh issue in this particular case? 22 lakh 50. And what is the issue price, everyone? Your issue price in the first case is nothing but what? 150. Okay. So in this particular case, can you please tell me what is the number of equity shares? It is 15,000 shares. Okay. But then they have told you that it is expected to decline to 125 in case the funds are borrowed in excess of what? Rupees 10 lakhs. So in which plan are we borrowing the funds which is in excess of 10 lakhs? Third plan. So there the market price should be dash. Can I say there the market price should be dash? 125. But what about the second case? The market price will be what? Can I say that will continue to be dash? 150. Okay. Because this is not exceeding 10 lakh. This is up to 10 lakhs. So only if it exceeds 10 lakhs, the market price is going to fall to what? 125. So can you please give me the number of equity shares here? This will be 10,000 shares. And if I take 15 lakh and if I divide that by 125, what is going to be the final answer? 12,000 shares. So these are the total number of equity shares which you have got. So third plan, equity is 10 lakh, sorry. Equity is 10 lakh, and if I divide that by 125 because equity is 10 lakh, sorry. So how much is the number of equity shares which is coming as? 8,000 shares. You are right. So equity should be 10 lakhs. So 10 lakhs we have to divide that by 125. Okay. Now, what is your starting point, beta? We are going to start with your EBIT. Do you have the EBIT in the question? Hello. What is the amount of the EBIT which we have? 5 lakhs. So is this going to be your starting point? Come on, yes or no? Okay. From this EBIT, what do you have to subtract? Interest to get what? EBT. Now it is important that how should we calculate your amount of interest? Can you please tell me, whenever I'm talking about interest, just check what is given to you. The funds can be borrowed at the rate of 10% up to 2,50,000. So if we are taking the debt up to 2,50,000, what is the amount of the interest which we are going to pay, beta? 10%. In the first plan, am I raising the debt up to 2,50,000? Come on, yes or no? Yes, sir. So what is going to be my amount of interest, everyone? 25,000. Solo yaar. So can I say first plan your interest is going to be what? 25,000. So can you please give me now what is going to be the interest for the second plan? But they have told you at the rate of 15% over 2,50,000 and up to rupees 10 lakhs. So in your plan 2, how much funds are we raising? Just check how much funds are we raising? 10 lakhs. Now in this 10 lakhs, can I say we have to apply your slab rates for the purpose of calculation of your interest? So in this 10 lakhs, can I say up to 2,50,000, what's the rate of interest which is being charged? Everyone, 10%, so that is going to be 25,000. And after 2,50,000 to 10 lakh, what's the remaining part, beta? Can I say 7,50,000? And this I have to multiply it by how much percentage? So what's the rate of interest which is there? 15%. Can you please give me 15% of 7,50,000? 1,12,500. Now what's the combination of this beta? 1,37,500. Can I say this will be the interest for the second plan? Come on, yes or no? Yes, sir. And what about the third plan now? For the third plan, can you please tell me what's the amount of the loan which you are raising? What is the amount of the loan which you are raising? 15 lakhs. And they have told you, and over and above 10 lakhs, the rate is what? 20%. So the amount of the loan is nothing but 15 lakhs. So can I say up to 2,50,000, my rate of interest will be what? 10%, that is going to be 25. Then beyond that, it is going to be 7,50,000, which I have to multiply it by 15%. And how much is that going to be, beta? 1,12,500. And what's the remaining part, beta? 5 lakhs. And this 5 lakhs will be multiplied by how much percent? 20%. So how much is this going to be? 1 lakh. So can you please give me the total amount? 2,37,500. Can I say this will be the interest for the third part? Solu yaar. So the only important part of the question was, how do you calculate the amount of the interest? And now is it very much manageable? Come on, yes or no? Yes, sir. Okay. So with the help of this, now your question number 13 will also be completed. Okay. So see, these are the interest working which we had also calculated. Okay. Now let us start with your illustration 14. Okay. Now see what is given to you in your illustration 14. Let's read this particular question. Okay. Are you guys ready? Okay. So now let us do your illustration 14. See what is given to you. Let's read in this question. The following data are presented in respect of Quality Automation Limited, in which there is EBIT which is given to us how much amount? 52 lakhs. We have less interest on debentures which is nothing but 12 lakhs. We'll be having your PBT which is 40 lakhs. From that, what do we have to subtract, beta? Tax. Then NPAT is given to you, number of equity shares. We have your EPS, and then we also have your PE ratio. After which they have told you that EPS into P ratio will eventually give you what? Market price per share. Now the company is planning to start a new project requiring a total equity outlay, total capital outlay of rupees 40 lakhs. Can you please tell me what is the new funds requirement? Come on, yes or no? 40 lakhs is given to you. Okay. You are informed that your debt equity ratio, which is debt upon debt plus equity, if it is higher than 35%, then the KE will push to 12.5%. which means that it is going to reduce the PE to 8 times, and it will rise the interest rate on additional amount borrowed to 14%. Now, what is going to be the PE ratio and what is going to be the new interest rate is dependent on one particular condition. What is that condition, guys? The condition is that your most important part is your debt equity ratio should not be higher than 35%. If the debt equity ratio is higher than 35%, then can I say that the PE ratio will fall for the company? Come on, yes or no? Yes, sir. And also at the same time, what is going to happen to the rate of interest on additional borrowing? Are we going to borrow at a higher rate? Come on, yes or no? Yes, sir. Find out the probable price of the share if additional fund is raised by the way of loan, and if your additional amount is by the way of issue of equity shares. Note that the retained earnings of the company is 1.2 crores. Okay. Now in this particular case, does the company has some existing capital also? Come on, yes or no? Yes, sir. But this existing capital structure, now it is not mentioned in the question. If the existing capital structure is not mentioned in the question, the first part is, you know what? We are going to start with the existing capital structure. Now in this existing capital structure, please tell me which all things do you have? Do you have, first of all, number of equity shares? Okay, so now definitely the company has some equity share capital. What is the equity share capital, beta? 8 lakh of rupees 10 each. So can I say these are 8 lakh shares of rupees 10 each? So 80 lakhs. Come on here. Because they have given the wordings number of equity shares. So this is 8 lakh number of shares. Okay. Also at the same time, do you have the debentures interest available? Come on, yes or no? Yes, sir. So do we have some debt also in the question? Come on, yes or no? Yes. Can you please tell me what's your 12% debt which they have given to you? So that will be nothing but your interest amount, which is 12 lakhs. And this 12 lakhs, I will divide that by 12%. Ultimately, I'll be getting the amount of your loans, okay, which is called as your capitalization. If you have the interest amount and if you have the rate, don't you think you can find out the amount of your debt? Come on, yes or no? Yes, sir. Can you give me the amount of the debt? 1 crore. And also, by the way of note, have they mentioned some reserves and surplus also? Come on, yes or no? Yes, sir. What's the amount of the reserves and surplus, guys? 1 crore 20 lakhs. Come on, yaar. So what is going to be the final answer now? If you do this, what is going to be your capital which is being employed? Can you please tell me what's the capital which is employed? What is this? 3 crores? Tell me, yaar, what is it? Okay, so 3 crores is nothing but your what? It's your existing capital which is being employed. Okay, and now after that, are we requiring some additional funds? Come on, yes or no? Yes, sir. What is the additional funds which is required, beta? 40 lakhs. Okay, so now I can prepare my summary of financial plans. Hello? And in this summary of financial plans, I'll be having plan 1, plan 2. Okay, and here in plan 1 and plan 2, I will first check how am I raising the funds in the first plan. Are we raising the entire funds by the way of dash? Loan. So what is the amount of the loan, guys? Can I say it's going to be entirely 40 lakh rupees? Okay, and there is no equity. And in the second plan, we are raising the entire funds by the way of equity. So this is the total amount which we require. Come on, yes or no? Yes. But it is important that we also write down your number of equity shares. So what are the two types of number of equity shares? Can I say there will be existing and there is going to be your fresh issue? Can you please tell me what are the existing number of equity shares which is already there in the question? It is nothing but 8 lakhs. So there is no problem regarding existing number of equity shares. We are just going to deal with your new equity shares. So new equity shares, can you all please tell me that what is going to be your market price of an equity share? Just check what's the market price of an equity share. 25. So please tell me it's a hidden adjustment. The new shares which will be issued, will it be issued at your face value or it will be issued at market price? Okay, because in both the previous questions, the issue price was given to you. Here is the issue price given to you, then the answer is no. But already the existing shares are traded at 25 rupees. So don't you think your new shares will be issued at what? It will be issued at market price. So what's the market price which is given to you at 25? So now can you all please tell me, for your new shares, you will take 40 lakhs and divide that by 25. What is the number of equity shares? Sorry? 1,60,000. So can I say I'll be having 9,60,000? Come on, yes or no? Yes. And this will continue to be what? 8 lakhs. But then it is also very much important for you to understand what is the debt equity ratio of the company. So usually your debt equity ratio is nothing but debt upon equity. But now is this, what happened? Oh, okay. Plan 2. This is 8 lakhs and this is going to be 9,60,000. Okay, you can tell me, it's okay, no problem. Okay, so this is nothing but 9,60,000. Perfect. Okay. Now, what's your debt equity ratio, guys? Debt equity ratio. Generally, what's the formula for debt equity ratio, everyone? Debt upon equity. But here, what have they mentioned? What your debt equity ratio should be? Debt upon debt plus equity. This is how we are going to do the calculation. So it should be debt upon debt plus equity. Can you all please tell me what is the amount of the debt in your plan 1? This is 40 lakhs and this is nothing but what? 1 crore. So the total debt is what? 1 crore 40 lakhs. And this is going to be on your total capital which is employed. So your existing capital employed was what, beta? 3 crores. And what's your further capital which we are taking? 40 lakhs. So this is going to be 3 crore 40 lakhs. Can you please give me how much percentage is this? 41%. So approximately this is 41%. Is this greater than 35%? So for your plan 1, what do you think should be your PE ratio? 8 times. And what should be your cost of debt for additional funds? So it should be what? They have told you now that the cost of debt should be what? 14%. Come on, yes or no? Yes, sir. So this new debt will be at the rate of what? It's going to be at the rate of 14%. But in the second case, let us just check what's the amount of the debt which we have? 1 crore, which will divide that by 3 crore 40 lakhs into 100. Can you give me this percentage? How much is this going to be? 29.4%. Can I say this is less than 35%? Hello? So will the PE ratio continue to be at 10 times and there is no new cost of debt which will be taken into consideration? Have you all understood this? Okay. But now the starting point is it should be EBIT. But for your this particular case, we don't have any EBIT. Do you have any EBIT given to you that the new capital, how much EBIT is it going to generate? Have they mentioned that? No. So always remember that whatever is your existing return on capital employed now, that existing return on capital employed will also be taken into consideration when we are raising funds by the way of after expansion. So in this particular case, what was my EBIT, guys? 52 lakhs. So what was my old EBIT? Old EBIT, how much was it? 52 lakhs. On the capital which was invested, that was nothing but 3 crores. How much percentage was my return on capital employed? Can you please tell me how much percentage was my return on capital employed? Can you give me return on capital employed old? How much is this? 17.33%. Now can I say for your new capital also will be earning 17.33% only. So now how much was your new capital employed? 3 crore 40 lakhs. If I multiply this by 17.33%, can you give me the answer? 58 lakh 92,200. So this is going to be your new EBIT, that is EBIT after expansion. Now in this particular case, if you guys can just check, you will come to know that we are going to start with 58 lakh 92,200. Is this going to be your new EBIT? Come on, yes or no? Yes, sir. Now the question becomes extremely easy. It becomes very similar to what we have done earlier. From EBIT, what do you have to subtract? Interest, old and whereas new. And then there will be EBT, tax, NPAT, number of equity shares, EPS, PE ratio. Then your market price per share will be 20.66 and 24.44. Okay. So then we have to check that which is the better option and we have to take that into consideration. Superb. Have you all understood this? So can I say with this all the illustrations are done? Come on, yes or no? Okay. Now let us start with your practical problems. Okay. Are you guys ready with this? Okay. Chalo. Practical problems. Okay. Now let us start with your practical problems. Let us start with your first question. ICAI Limited is considering a new project which requires a capital investment of what? 9 crore rupees. Interest on term loan is nothing but 12% and the corporate tax rate which is given to you as 30%. Calculate the point of indifference for the project considering debt equity ratio insisted by the financing agency, that is 2:1. So now in this particular case, I want to calculate what? Indifference point. So there has to be two plans to calculate the indifference point. Now in your two plans, what is the total amount which is required? Everyone just check and tell me. What is the total amount which is required? 9 crores. So we have a total amount which is nothing but 9 crores. But now in this particular case, they have not given to you that there are two structures, but it is common sense that when they have told you that the debt equity ratio insisted by the management is 2:1. So it means that in the very first plan, how much is the debt which we are going to take, beta? Can I say this is 2:1? So this should be 2/3 and this should be 1/3. So can I say 3 crores should be your equity and your debt should be what? 6 crores. So in your first plan will be your debt equity ratio 6 and 3. Come on, yes or no? Yes, sir. In the second plan, what do you think should be your capital structure? Can I say the entire 9 crore should be your equity only? Because there can't be any debt. Okay, so because we cannot have 100% debt. If the debt has to be insisted, that is 2:1. So we can only take debt up to the extent of 2/3 and 1/3. So that is by 6 and 3. And if we can't take debt, then what is the balance part? Equity. So the entire amount will be by the way of equity. Now they have not given to you any face value of the equity share. So let us assume that the face value of the equity share to be what? Rupees 10 each. So can I say here there will be 30 lakh shares. Come on here. And here it will be what? Number of shares? 90 lakh shares. Okay. Now we have to calculate the indifference point. Please tell me what is the percentage of debt which they have mentioned here. What's the percentage of debt they have told you? 12%. 12% is the cost of debt. Okay. Now what is indifference point? Your EPS of plan 1 should be what? Equal to dash. EPS of plan 2. Solo yaar. Okay. Now how do you calculate your EPS? Everyone. Can I say we will start with your EBIT. What do you subtract? Interest. What do you get? EBT. Then we multiply that by 1 minus tax. That is nothing but net profits after tax. And who has the first right over the profits? Preference dividend. So can I say this is nothing but net profit for equity shareholders? If I divide that by number of equity shares, will I get the EPS of plan 1? Come on, yes or no? Yes, sir. And this should be equal to what? my EPS of plan 2. Solu yaar. Okay. Now, what is your EBIT beta? Can I say this is X? Okay. Can you all please give me what's the amount of the interest? So that is nothing but what? 6 crores multiplied that by how much percentage? 12%. So 6 crore multiplied by 12%. Can you give me what is this? So 72 lakhs is nothing but the amount of the interest. What's the tax rate? What's the tax rate? The tax rate they have told you is nothing but what? 30%. And there is no preference dividend. Okay, is this correct, beta? Okay. And then we'll be getting the number of equity shares. So what are the number of equity shares in the first case? 30 lakhs. And this should be X minus. Is there any interest in the second plan? Come on here. And this we are going to divide by how many number of equity shares? 90 lakhs. Now, can I say this data is sufficient to find out what should be the value of X? So once you solve this, you'll be getting your indifference point. That is the first part of the question. Superb. Have you all understood this? Okay. And now if I also tell you to verify the same, how will you verify this? So whatever is the EBIT which you have got, if I take plan 1 and plan 2, this particular amount of EBIT which I have got, from that if I subtract interest, EBT, tax, etc., then can I say I'll be getting the EPS for both the plans? And once I get the EPS for both the plans, then we should select that which plan should be considered to be better. Okay, so this is the process which we are going to follow. Okay, so this is your practical problem 1. Now let us start with your practical problem 2. Now see what is given to you in practical problems 2. Xylo Limited is considering 2 alternative financing plans, and in this there is plan A, plan B. We have equity share of rupees 10 each. Can you please tell me what is the amount of equity share capital? 8 lakhs. What's the face value? 10 each. So what are the number of equity shares? 80,000 shares. Here again, what are the number of equity shares? 80,000 shares. We have preference shares for plan A 0, for plan B it is 4 lakhs. Then we have 12% debentures which is 4 lakhs, and here there is no plan. Okay, there is no debentures. Can I say the total amount is what? 12 lakhs and 12 lakhs. Now we are required to calculate the indifference point. The indifference point between the plan is given to you as 4 lakh 80. We are required to calculate the rate of your preference dividend. So for a change, now in this particular question, what is given to you? Indifference point is given to you. What is required to be calculated? Your preference dividend rate is required to be calculated. So can I put it like this, that in this particular question, we have already your EBIT in this question. So it means that now what should be your X? Can I say it should only be your preference dividend? So if I substitute the values here, what should be my approach to the question? Everyone, please tell me, what is the indifference point, beta? 4 lakh 80. So let us talk about plan 1. So if it is this 4 lakh 80 minus, what's the amount of the interest, guys? Do you have any amount of the interest? Yes or no? Yes, sir. And that is going to be 4 lakh multiplied that by your 12%. What is the amount of the interest? 48,000 into 1 minus, what's your tax rate, everyone? Come on, tax rate is 30%. And then this will give you your NPAT. Is there any preference dividend in the first plan? No. And this I will divide it by total number of equity shares, which is 80,000. Come on, yaar. And for the second case, your EBIT is 4 lakh 80. Is there any interest? Just check. No, there is no interest. Into 1 minus 0.3, and let the preference dividend be X, and this is 80,000. And once you solve this, you will be getting the amount of preference dividend. This will be in rupees. But they have asked you amount or they have asked you percentage. Percentage. So do you have the preference share capital amount available? Come on, yes or no? Yes, sir. So whatever preference dividend you get, you divide that by preference share capital into 100. You will be getting the percentage part. Okay. So whatever is the preference dividend, whatever you get, you divide that by the preference share capital and multiply that by 100. Ultimately, you will be getting nothing but the rate of preference dividend. Are you all okay with this? Okay. Now this was your question number 2. Now let's do your question number 3. Now see what is given to you in question number 3. Ganesha Limited is setting up a project with a capital outlay of what? Rupees 60 lakhs. Now it has 2 alternatives in financing the project cost. Alternative 1 is what? 100% equity finance by issue of equity share of rupees 10 each. And then alternative 2 is debt equity ratio. The rate of the interest payable on the debt is what? 18%. Corporate tax rate is given to us 40%. We are required to calculate the indifference point. How will you calculate the indifference point, guys? Can I say, first of all, you have to prepare 2 plans. Okay. Please tell me now, what is the total amount which is required, guys? 60 lakhs. So we have the total amount which is required, that is 60 lakhs. Are you seeing how this summary of financial plan is making things very easier for you? Okay. So always prepare this summary. Now there are two options which are available, either by debt or either by equity. In plan 1, how are we raising the funds? Just check. Can I say it's 100% by the way of what? Equity. So can I say 100% is by the way of equity? So this 60 lakhs is entirely here. There is no debt in the capital structure. In the second plan, are we having debt equity ratio? Come on, yes or no? Yes, sir. 2:3. So can I say this will now be 2/3 and this will now be 1/3? So how much is this going to be, beta? 40 lakhs. And how much is this going to be? 20 lakhs. Solo yaar. Okay. So this is going to be now what is going to be your capital structure. What about your number of equity shares? So for number of equity shares, have they specified that there should be what? Issuing at face value of what? Rupees 10 each. So can you please tell me the number of equity shares, guys? 6 lakh shares. And here it is what? 20 lakhs. So which is going to be what? 2 lakh shares. Okay. Now what is required to be calculated? What should be your indifference point? So again, can I say EBIT? Let that be X minus first plan. Does it have any debt? Come on, first plan. Does it have any debt? No. 1 minus, what's the tax rate? 40%. Then is there any preference dividend? No. Divide that by what is the number of equity shares? 6 lakhs. Can I say this should be equal to X minus what is your interest in the second plan? Just check. What's the rate which is given to you? 18%. So can I say I will take 18% of what? 40 lakhs. So what is 18% of 40 lakhs? 7 lakh 20. So this is 7.2 lakhs. And then into 1 minus 0.4. Is there any preference dividend? No. And this is 2 lakhs. If you solve this, we'll be getting the indifference point. Come on, yes or no? Yes, sir. And once we get the indifference point, then what next we have to do, beta? We have to do the verification of the same. And once we do the verification, we'll come to know that the EPS under both the plans are going to be what? It's going to be the same. Very much manageable, guys. Okay. So now with this, your question number 3 also gets completed. Now let's do your question number 4. Okay. Now what is given to you in a question number 4, that Ganpati Limited is considering 3 financing plans and the key information is given to you. Okay. What is the key information? The total investment raised is what? 2 lakhs. So how much money is required, beta? 2 lakhs. Okay. And how many plans do you have? We have 3 plans. Okay. So what are the 3 plans, beta? Plan A, plan B, plan C. Plan A has what? 100% equity. Plan B has what? 50% debt, 50% equity. And plan C we have what? 50% equity and 50% preference shares. Cost of debt is 8%. Cost of preference shares is 8%. Tax rate is 50%. And the equity share of the face value of rupees 10 each should be issued at a premium of rupees 10. So can you all please tell me what's your issue price? Your issue price is going to be 20. Your expected EBIT is 80. We are required to calculate EPS, FBP and indicate if any one plan dominate the other, compute the EBIT range. Okay. Now this question, I want you to solve this with me because this has all the 3 parts. Okay. Will you do this? Okay. Chalo, let's go to your notebooks and write down. What is the first step, beta? What is the first step? Always, how do we have to start? Summary. Okay. This is which question, beta? Illustration question number 4. Practical problem number 4. Okay. We are going to start with summary of financial plans. Are you guys ready? Summary of financial plans. How many plans do you have, beta? 3 plans. Okay. We are going to have 3 plans. Now please tell me, in this 3 plans, we are going to have in plan 1, can I say entire is what? Equity. So this is equity, this is debt, this is preference shares. We are going to have your total amount. What's the total amount required? Everyone. The total amount which is required, that is nothing but 2 lakhs. Now it is important for you to first understand how are we raising this 2 lakhs. So can I say in plan 1, we are raising the entire 2 lakhs by the way of what? Equity. There is no debt, there is no preference shares. In plan 2, how are we raising the entire amount? How are we raising the amount? 50% of equity, which is 1 lakh. And 50% of debt, that is also 1 lakh. And then in plan 3, you all can check how much are we raising? 1 lakh by the way of equity and 1 lakh by the way of preference shares. What's the rate of interest? 8%. What's the rate of preference shares? 8%. Okay. Now, if I want to select, first I need number of equity shares. So are we issuing number of equity shares at your issue price of what? 20. Right? So what's the issue price? 20. So can you all please give me from fresh issue, if I divide by issue price, will I be getting the number of equity shares? Give me number of equity shares, everyone. 10,000 shares, then 5,000 shares, then 5,000 shares. Okay. What is going to be our starting point, everyone? How will we start? We will start with EBIT. Now, do you have the EBIT in the question? How much is that? 80,000. So that is going to be the starting point for all the three plans. Come on, yes or no? From EBIT, then what is the next thing? What are we going to do? We will be subtracting your interest. What will you get? EBT. Less what? Tax. What is the tax rate which they have specified, beta? 50%. So what will be finally getting, beta? NPAT. Then from this, what will you subtract? Preference dividend. What will you get? Net profit for equity shareholders. If I divide this with what? Number of equity shares. What will I eventually get? EPS. Are you all aware about it? Okay. Chalo, do the needful and you only calculate and tell me what's the EPS which is coming. Chalo, start. I want you all to approach this and give me the EPS. All the online students, you all also solve this. I want you all to please tell me what is the EPS which you have got. What is the EPS for plan A? 4. EPS for plan B. And EPS for plan C. Which plan is better? Plan B. Why? Because its EPS is minimum or maximum? Maximum. So that's the first part of the question. What's the second part of the question? We are required to calculate what? Financial break-even point. Can you please tell me what is financial break-even point? Can I say we have to take into consideration what is going to be your fixed financial cost? So what is your fixed financial cost, beta? Can I say interest plus preference dividend? This is going to be your fixed financial cost. Come on, yes or no? Yes, sir. And this, we have to divide that by 1 minus tax rate. So for plan A, plan B and plan C, please tell me in plan A, is there any interest? Is there any preference dividend? So is there any financial break-even point? No. So even if your EBIT is 0, it's okay. Your EPS is going to be 0. But for your plan B, is there any interest? What is the interest? 8,000. Is there any preference dividend? So you have to compulsory earn 8,000. Only then you can be at a financial break-even point. So you have to compulsory earn how much amount, beta? 8,000 rupees. But when it comes to plan C, is there any interest? No. Is there any preference dividend? Yes. And this preference dividend, I need to divide it with what? 1 minus tax rate. What's the tax rate? 50%. So in this particular case, what is the minimum EBIT I have to earn? 16,000 rupees. So these are my 3 financial break-even points. Have you all understood this? Okay. Then what's the third part of the question? We are required to calculate what? Indifference point. Now when there are 3 plans, how do you calculate your indifference point, beta? Can I say your indifference point can be calculated by taking into consideration, can I say by between plan A and plan B? Then we will take between plan B and plan C. And then we will take between plan A and plan C. So in this particular case, हमें plan A and plan B, इसका हमें calculate करना है, what should be your indifference point. So we have to calculate for this. So in this particular case, what we will do, we will use the same formula. What is that going to be? EBIT minus interest. Okay. So we'll be starting with between plan A and plan B. So can I say EBIT, let that be X. You can do this along with me. Between plan A and plan B, your EBIT is X minus. Is there any interest in plan A? Come on, yaar. So can I say this is going to be 0 into 1 minus. What's the tax rate? 50%. And then is there any preference dividend? And this is something which I have to divide by total number of equity shares. So what is the total number of equity shares? 10,000. Okay. And for plan B, is there any interest? How much is that? 8,000 into 1 minus 0.5. Is there any preference dividend? No. So this has to be what? 5,000. So in this particular case, can I say I can find out what can be the indifference point? So this will be cancelled and this will now be X by 2 is equal to X minus 8,000. So this is going to be X is equal to 2X minus 16,000. So this is going to be 16,000 is equal to X. 16,000, yeah, is equal to X. So can I say this is going to be your first indifference point? Come on, yes or no? Yes, sir. So your first indifference point is going to be what? Rupees 16,000. Have you all understood this? Okay, between plan A and plan B. You can complete this. Okay, between plan A and plan B, your indifference point turns out to be how much amount, beta? It turns out to be your 16,000 rupees. Okay. Similarly, you also have to do it indifference point between dash and dash. Okay, let's do it for plan B and plan C. Now, what is plan B? X minus. Is there any interest in plan B? Yes. How much is the amount? 8,000. Into what? 1 minus. What's the tax rate? 50%. Minus. What's the preference dividend? 0. I will divide that with what? 5,000. And this is going to be what? X minus. Is there any interest? No. So this is 1 minus 0.5. And is there any preference dividend? Yes. 8,000. Divide that by 5,000. Come on, yaar. In this way, can we do it? Come on, yes or no? Yes, sir. Now, this is very much evident. Can I say that your 5,000 gets cancelled and this will now be 0.5x minus 4,000. This will be again 0.5x minus 8,000. Did you realize your 0.5x gets cancelled? If you solve this, you will realize that 0.5x will be cancelled. So it means that there is no indifference point between plan B and plan C. There is no indifference point. Which plan is dominating which plan? Please tell me. Can I say your plan B is dominating your plan C? So there can't be any indifference point between plan B and plan C. Why? Because can I say plan B pays interest of 8,000 and plan C pays preference dividend of 8,000. Don't you think that we will always prefer paying interest over preference dividend? Why do we prefer paying interest over preference dividend? Because we are going to save tax. So guys, between plan B and plan C, there can't be any indifference point. There can't be any indifference point. And which plan will dominate which plan? Plan B will dominate plan C. That's what they have mentioned, see? And indicate if any plans dominate. So can I put it like this, that plan B dominates which plan? Plan C. Why? Because interest leads to dash, leads to tax savings. So if you are a CFO of a company and if I ask you that should you pay 8,000 interest or should you pay 8,000 preference dividend, what is going to be your final answer? Interest. Why? Because by paying interest you are saving dash. Tax, come on, yes or no? Yes, sir. So this is one of the benefit. So that's why there can't be any indifference point between dash and dash, between plan B and plan C. Superb. Are you all convinced? Everyone is okay? Sure, confident guys? Come on, yaar. Okay, so there can't be any indifference point. Your X will only be cancelled. So there can be such kind of domination plans also. Okay. What is the last thing which we have to do, beta? We have to calculate the indifference point between what? Plan A and plan C. Can we do that? Come on, yes or no? Yes, sir. So just check. X minus plan A. Is there any interest? No. Into 1 minus 0. What's the tax rate? 50%. Minus 0 upon 10,000 shares if I'm not wrong. And plan C will be X minus 0 into 1 minus 0.5 minus what? 8,000. This will give you 5,000. Now see here, please don't directly cut 1 minus 0.5 because there is 1 minus, there is 8,000 also which is there. So this is now going to be what? 0.5x upon 2 is equal to 0.5x minus 8,000. So if I take this here, this will be 0.5x is equal to 1x minus 16,000. So guys, here it is going to be 16,000 is equal to 0.5x. So what's your indifference point? 32,000. This is going to be your indifference point between plan 1 and plan 3. Superb. Have you all understood this? So that's why I told you to solve this particular question so that everything gets covered here. Okay. That is indifference point, financial break-even point, everything. Okay. And your calculation of EPS. Are you all convinced? Okay. Clear? Okay. Chalo. Great. Now with this, your question number 4 is also done. Now let's do question number 5. Now see what is given to you in question number 5, that Yo-Yo presently has rupees 36 lakhs debt which is outstanding, and this is bearing an interest rate of what? 10%. And it wishes to finance rupees 40 lakhs expansion program and is considering 3 alternatives: additional debt at the rate of 12%, preference shares with 11%, and issue of equity share of rupees 16. The company presently has 8 lakh shares outstanding and is in 40% tax bracket. If the EBIT is presently rupees 15 lakhs, determine the EPS under the three alternatives, assuming no immediate increase in your profitability. Okay. So in this particular case, question number 5A. What is asked in the question that we are required to calculate what? What should be the EPS under the three plans? Okay. Now, what is my first part? Always, we have to start with what? Summary. Come on, yaar. How many plans do we have? We have three alternatives. Okay, so plan 1, plan 2, plan 3. Now, how are we raising? Additional debt of 12%. Okay, so we are taking in the first plan entire amount by the way of debt. How much amount is required, guys? We require 40 lakh rupees. So in the first plan, how are we raising the entire amount of the debt? How are we raising the entire amount by the way of debt? In the second plan, there is preference shares with 11% preference dividend. So 11% preference share capital. Can I say in this particular case, we are raising the entire money by the way of what? Preference share capital. Solu yaar. So that's how this 40 lakhs is going to come. And in the third plan, you all can just check that we are going to issue what? Equity shares. Okay, so here it's going to be 40 lakhs, entirely equity shares. Come on, yaar. Okay. Now we also have to write down what is the number of equity shares. Is there any old equity shares in the company? Yes, just check. The company presently has how many number of equity shares? 8 lakhs. So what's your old shares, guys? So can I say your old shares is nothing but 8 lakhs? Solu yaar. So this is 8 lakhs, 8 lakhs, 8 lakhs. Okay. Now what about the new shares? New shares. Can I say that is going to come in which plan? We need to check this out. So can I say in case of the new, will it come in plan 1? No. Will it come in plan 2? No. Will it come in plan 3? Yes. And have they given to you what's the issue price? 16. So can you please give me the new number of equity shares? You will take 40 lakh, you will divide that by 16. Tell me. How much is it? 2 lakh? 50,000. Now, do I get the total number of equity shares, guys? What's the total number of equity shares? 8 lakhs, 8 lakhs, and how much is this? 10 lakh, 50,000. Okay. Now, they have told you that if the EBIT is what? 15. Okay. So, whatever is the existing, we are continuing with that only. There is no increase in profitability, something which they have mentioned. So, I will start with EBIT and interest. Is there any old capital, old debt in the capital structure? Come on. Yes or no? Yes, sir. Shri, that was given to you in the question. See, the company has 36 lakhs debt. And what is the rate of interest? 10%. So is there any old interest? Come on, yes or no? Yes, sir. What's the old interest, guys? So that is going to be what? 36 lakhs multiplied by what percentage rate? 10%. So this will be what? 3 lakh 60. Right? So this is going to be your 3 lakh 60. Okay. And then at the same time, what is going to be your new interest? It depends. Which structure are we following? Are we following plan 1? Is there any debt in plan 1? Okay, so that is 40 lakhs into 12%. Give me this. 4 lakh 80. Now in your plan 2, is there any debt? No. In plan 3, is there any debt? No. I'll be getting EBT. From EBT, what will I subtract? Tax. What will I get? NPAT. And then from that, if I subtract preference dividend, what will I get? Net profit for equity shareholders. I will divide this with what? Number of equity shares. What will I get, beta? EPS. Are you all convinced by this? Okay, this is very easy to solve. Okay, so we will be getting your EPS. We are going to start with the EBIT amount. Can you all please give me what's the amount of the EBIT which we are going to start with? What is the amount of the EBIT which we are going to start with? In the question only they have specified. That is nothing but what? 15 lakhs. Okay. So I can get my EPS based on this entire data. Perfect. Okay. So are you solving this? You can give me the EPS. Okay. Please solve this and give me the EPS which is coming for all the three plans. Your time starts now. So you should be getting your EPS. What's your EPS, everyone? 0.495. Second one, 305. Third one, 651. So these are the three EPS which you have got. Okay. Please tell me which plan will you select. Plan 3 should be selected. Okay. Plan 3. Why? Because the EPS is what? Maximum. So this first part is very much manageable. You all must have understood this. What about the second part? Analyze which alternative do you prefer. We have already discussed plan 3. But compute how much would EBIT need to increase before the next alternative would be the best. Now please tell me which is the next best alternative. Plan 1. Okay, so the next best alternative is plan 1. Okay, so what I need to do now, I have to now calculate what should be the indifference point between plan 1 and plan 3. What I need to calculate beta indifference point between what? Between plan 1 and plan 3. Okay, so how will we do this? Let the EBIT be X. What is the interest for plan 1? Be very careful. Interest for plan 1 is the total of this two. So what is the interest for plan 1? Do this along with me. 3,60,000 plus 4,80,000. How much is this? 8,40,000. Come on, yaar. Okay. What's your tax rate, guys? 40%. Is there any preference dividend? No. What are the number of equity shares for plan 1? 8 lakhs. Okay. And this is equal to X minus. Is there any interest for plan 3? For plan 3, is there any interest? Yes. It is 3,60,000. So it is 3,60,000 into 1 minus, what's the tax rate? 40. And what is this total, which is going to be 8, how much number of equity shares? 10,50,000. So this is for your plan 3. Now, let us do this calculation. So you will come to know that this will be done. And this is now going to be 80 and 105. Okay. So in this particular case, if I take 105, okay, so this, if I divide this by 15, no, not 15, because if I divide this by 5, so this will now be what? This is going to be 16, and this is going to be what? This will be now 21. Okay, so if I take this here, this will now become 21x minus 21 into 8,40,000. I'll be getting 1,76,40,000, and this should be equal to 16x minus, if I take 3,60,000 and multiply that by 16, this will be what? 57,60,000. So if you solve this, so this will now become 5x is equal to, and this will now become 1,764,000. So this is now going to become what? This will be 1,18,80,000. And if you find the value of x, this is now going to be 23,76,000. Everyone should get this EBIT as 23,76,000. Now, once you have got the EBIT of 23,76,000, now what is the significance of this? Now just understand. See, always remember that if you are earning up to 15 lakhs, okay, which is below this indifference point, then plan 3 is coming much better. But if you earn 23,76,000 or more than 23,76,000, na, if you earn more than 23,76,000, then which plan will be better, do you know? Then your plan 1 is going to be better. So now in this particular question, I am just explaining you one concept which I wanted to pay attention. Okay, so listen to this very carefully. Okay, see guys, if your expected EBIT is equal to your indifference point, if your expected EBIT is what? Equal to indifference point, then can you all please tell me, we can go with any plan. Hello? What is the indifference point? 23,76,000. So if your EBIT is 23,76,000, we can go with any plan. But if your EBIT is less than indifference point, then select the plan in which FBP is lower. Select the plan in which the risk is lower. In this case, your EPS will be higher. Okay. So just check. Your EBIT was 15 lakhs. Solo yaar. Your EBIT was 15 lakhs. Was that less than 23 lakh 76? I am asking you. Was that less than 23 lakh 76? Come on. So if it was less than 23 lakh 76,000, then which plan was coming better? Plan 3 was coming better, because plan 3 was only equity. There was no FBP in that. So automatically that plan 3 was coming better. But if your EBIT is greater than indifference point, if your EBIT is greater than indifference point, example 25 lakhs, is this greater than 23 lakh 76,000? Then select the plan in which the FBP is higher, risk is higher. In this particular case, the EPS will be higher. So please tell me that if your EBIT is going to be more than 23 lakh 76,000, then which plan is better? Plan 1 is better, because plan 1 has dash debt in the capital structure. You can get benefit of leverage. So that is only possible when your earnings is high. When your earnings is low, always select the plan in which the risk is lower. But when the earnings is higher, then always select the plan in which the risk is higher. You will get the benefit of leverage. Your EPS will also be higher. Did you understand this relationship? So please write down this particular part. Just complete this part. So that is why, based on this, you will understand that if your income is going to enhance, definitely there is going to be a better possibility that there is going to be a better returns. So now just check and tell me, guys, in which particular plan do you think that your EBIT was, it is indifference point is nothing but how much amount beta? What the indifference point? 23 lakh 76,000. So my existing EBIT is what? 5 lakhs. So can I say if I increase this by 8 lakh 76,000, only after that can I say plan 1 can be much better? Because plan 1 has debt in the capital structure, it will have a higher FBP. So there will be higher risk. So when can plan 1 will be much better, beta? Can I say plan 1 will be much better when your EBIT is greater than dash? It is greater than your indifference point. So only then your plan 1 is going to be much better. Superb. Everyone understood this? Okay, great. Chalo. This was your question number 5. Question number 6. Now let us read this question. What is given to you? That Alpha requires funds amounting to what? 80 lakhs. And to raise the funds, the company has following two alternatives: to issue equity share of rupees 100 each amounting to 60 lakhs and to borrow the balance amount at the rate of 12% per annum, or to issue equity share of rupees 100 each and 12% debentures in the equal proportion. The income tax rate is nothing but what? 30%. We are required to calculate the indifference one. This is a very basic question, guys. You can definitely approach this particular question. You just have to calculate IDP based on the summary. So this is something which you all can do it. Okay. Now let us come to your question number 7. 1/3 of the total market value of Sangmani consists of loan stock, which has a cost of 10%. Another company, Samsui, is identical in every respect of Sangmani, except that its capital structure is an all equity and its cost of equity is 16%. According to approach, if we ignore taxation and tax relief on debt capital, we are required to calculate the cost of equity of Sangmani. Okay. How should you interpret this question? Everyone will do this along with me. This is now question number 7. Okay. There is one company, Sangmani. So first write down Sangmani. Okay. And this Sangmani consists of loan stock. So is there any debt in Sangmani? Come on, yes or no? Yes. What is the cost of that? 10%. So debt cost is 10%. Another company is there, Samsung. Okay, and this Samsung is what? This is very much identical as compared to Sangmani. It must be having the same EBIT, except that its capital structure is all equity. Okay. So now what is your equity here? Here can I say it's going to be entire 1 rupees by the way of equity. But when I talk about Sangmani, What is your debt proportion? 1/3 of the total market value consists of loan. So can I say this is 1/3? So this has to be what? 2/3. Solo yaar. Okay. And this is entire one equity. There is no debt in the capital structure. Then what is the cost of equity which they have given to you? What is the KE which is given to you? Okay. Samsung has a KE which is given to you as how much percentage? 16%. Okay. And they have told you are required to calculate what should be the cost of equity of Sangh money. We are required to calculate what should be your KE for Sangh money. This is what is being asked in the question. Come on, yaar. Okay. And they have told you which approach are we going to use? Approach. What we have learned under approach without tax? Can I say that the value of the company is going to remain same and your overall cost of capital is also going to remain the same? Can I say your KO and the value of the company both is going to remain constant irrespective of whatever is there in the capital structure? Come on, yes or no? Yes, sir. So your KO and the value of both the companies are going to be what? It's going to remain the same. Okay. So now, can you all please tell me if KE is 16%, what do you think is the KO of Samsung? This is 16%. Come on here, because there is no debt in the capital structure. So KE is what? 16. So KO is also what? 16. So what is the KO of Sangh money? 16. Did you understand this? Okay, because K is 16 and there is no debt. So that's why this is also 16. So your KO is also going to be 16. Because under approach, the change in capital structure will not have an impact on KO. And the market value of the company is always going to remain the same because of arbitrage process. So that's why can I say your KO is going to be 16%? Come on, yes or no? Yes, sir. So now my dear students, can I put it like this? That if I have debt and equity, what is my debt? 1/3. 1/3 is, can I say 0.33? What's my equity? Can I say 0.67? Now, what is the cost of debt? 10. What's the cost of equity? X. And the total is nothing but what? 16. Can I find out what is my KE? Come on, yes or no? Yes, sir. So this will be 3.33 and this will be 0.67x. So can I put it like this? 3.33 plus 0.67x, that will give you 16. So 0.67x will give you what? 16 minus 3.33. So that will be 12.67. So what is going to be your x? If I divide that by 0.67, I'll be getting this as 18.91%. So this should actually be your answer. Which is this solution to question number which? 7, hai na? Just check this out. It should be 19%. We have got the answer 18.91, approximately 19%, because we have just taken up to 2 decimals. If we take up to more decimals, we'll be getting the same answer. But did you understand how easy it is if you interpret it very properly? You all want to copy this down? Okay. In this way, you can just copy this. Okay. Copy this first. Because institute solution for this is slightly different. Okay. It means they have calculated like this, 2/3, 1/3 KE, etc. And we have just done it like this in our normal way. So this is coming as your 19%. Okay, so now let us continue with your question number 8. See what is given to you, that the following data relates to the two companies belonging to the same risk class. For A, we have the EBIT of 18 lakhs and here there is debt which is given to you, equity capitalization rate is not given. And for B, debt is dash and equity capitalization rate is given to us 18%. Required, determine the total market value of equity, equity capitalization rate and weighted average cost of capital assuming no tax as per approach. So first part is we are required to calculate when there is no tax as per and the second part is what will be the market value equity and WACC for each company assuming 40%. Okay, now let's approach this. Let's do this together. This is now solution to your question number 8. Okay, see, do you have EBIT available? Okay, so first I'm writing down without tax. So we have A, we have B, we have EBIT. What's the amount of EBIT, guys? We have EBIT which is 18 lakhs. From EBIT, what do you have to subtract? What do you get? EBT. And because it's no tax, can I say this itself is your net profits? which is nothing but the dividend. Come on, yaar. Yesterday only we discussed this. Now, for your first plan, do you have any debt? For your first company, do you have any debt? How much is that? 54 lakhs at the rate of 12%. Give me interest. 6 lakh 48,000. So, what is your dividend? 11 lakh 52,000. For plan B, is there any interest? No. So, this is going to be 18 lakhs. Solo yaar. Okay. And they have given to you that plan B has the equity capitalization rate of what? 18%. Okay, so we have KE available, but that is for plan B, which is 18%. And we are required to calculate what is the market value, equity capitalization rate, and WSCC for each company. So at least can I put it like this? I have KE for plan B. So can I say my KO for plan B is also 18? Hello, yaar. And if my KO for plan B is 18, what do you think my KO is going to be for plan A? 18. Now can I calculate KE? How will you calculate KE, guys? Can I say for that we should have what? Debt, equity. What is the amount of the debt which we have? Have they given to you debt? 54 lakhs. But do you have any equity till now? What is the value of the equity? Just check. No, 18 lakhs is not value of equity. That's your EBIT. That's your EBIT. But can I say I can calculate what can be the value of the company? Because if I have KO available, can I say that KO is nothing but EBIT upon market value of company into 100 yaar? So can I say what is the market value of firm? EBIT upon KO. So what was my EBIT beta? 18 lakhs. If I divide that by the KO, which is 18%, can I get this will be nothing but 1 crore. Did you realize this? Okay, first let me complete this, then you can copy. I have my KO, I have my market value of the company which is coming as what? 1 crore. In this 1 crore, do I have any debt and equity? Come on, yes or no? Yes. What was my debt? 54 lakhs. So what's my equity? 46 lakhs. So can I say my debt will be 46 lakhs? Solo yaar. So this is 1 crore. So this is 0.54. This is 0.46. Total is 1. What is the cost of debt? How much percent is it? 12%. Come on yaar. Cost of debt is 12. But what is the cost of equity? X. And what is the total KO? 18. So this will now become what? 12 into 0.54. That is 6.48. And this is 0.46x. So can I say 6.48 plus 0.46x is coming as 18. So 0.46x will now become 11.52. So what's your x? This should be coming as 25.04. So this should be your KE. So can I say for the first company, what's the name of the company? A. For A, we are required to calculate three things. Market value of company. What is your KE? And then they have told you to calculate KO. So for A and B, can I say your KO is nothing but 18? Right? And that is going to be the same because MM always tells you without tax, both the things are going to be the same. What's your KE? This is 18, but your KE is 25.04. And what is the market value of the company? 1 crore, 1 crore. This is the first part. Did you realize this? Okay, so you will come to know that under no tax approach, if you just check it, you will be getting your KE. Can you just check? 25.04. Superb. But just see our presentation. It is so easy for you to understand it. Okay. So this is the first part. Now what is the second part, guys? What is the second part, everyone? Determine again market value, KE and this when the tax rate is given to you as what? 40%. Right? So in this particular case, can I say that A and B from EBIT, what do you subtract? Interest. What do you get, everyone? EBT. What do you subtract? Tax. What's the tax rate? 40%. Solu yaar. So this will give you what? NPAT. Right? Now, please tell me, do you have your EBIT? How much is that? 18 lakhs. Okay. But in this particular case, you have your KE, which is nothing but what? 18%. Right? So now in this case, can you please tell me if your KE is 18%, just 1 second. KE for unlevered firm is given to you as 18%, right? So if the KE is coming as 18%, but here my EBIT should actually be different. 1 second. For A Limited, okay, 18 lakhs, yeah. Tax rate is this, okay. So if I talk about your A Limited, for B Limited, so it's very easy because you all can just check that what is going to be your interest is going to be 0. So this is going to be what? 18 lakhs. What's the tax rate, guys? 40%. So can you give me what is the tax amount? 7 lakh 20,000. So give me NPAT. 10 lakhs 80,000. So this is your NPAT, right? And if you just check what is the market value of B Limited. Now can I say B Limited is your unlevered company? Right? B Limited is your unlevered company. So B Limited's market value will be what? Whatever is going to be your dividend upon KE. Right? What's the dividend which you have got? 10 lakh 80. What's your KE which you have got? 18%. Can you give me the market value? 60 lakhs. So 60 lakhs is market value of unlevered company. Right? So if I'm talking about B Limited, what is its market value? 60 lakhs. What is its KO? 18%. What's your KE? 18%. So this is for B. But I have to do the same for A. But for A, you have to understand that it is a levered company. And whenever there is MM with tax, yesterday only we discussed that what is market value of levered company? Market value of unlevered company plus debt into tax. Plus debt into tax. Did you guys get this? So now what is the market value of unlevered company? 60 lakhs. Plus what's your amount of debt? 54 lakhs. What's the tax rate? 40%. Can you give me market value of levered company? 81 lakh 60,000. So that is market value of levered company. But now you are also required to calculate KE. So for KE, have I prepared the income statement? Yes or no? Yes. What's the amount of interest, everyone? Your interest is nothing but 6 lakh 48. So what is your EBT? What is your EBT? $11 lakh 52. You subtract tax and directly give me NPAT. Because this NPAT is nothing but your dividend, 6 lakh 91,200. Now please tell me how to find out KE for a levered company. We will take dividend and we will divide that with what? Market value of equity into 100. Now if you are wondering how to calculate market value of equity, so can I say market value of equity is nothing but market value of firm minus market value of debt. And have I already calculated market value of the firm? Yes, which is 81 lakh 60. What is the market value of debt? 54 lakhs. What is the market value of equity? 27 lakhs 60,000. So what's your dividend, beta? Your dividend is 691,200. So can I say I take 691,200, divide that by 27 lakh 60,000, multiplied by 100. What's your KE? 25.04. It should be the same. K is coming same. And what is your KO? So for KO, now I will prepare weighted average cost of capital. What is my debt? 54. What's my equity? 81 lakh 60. What's the total? Your total sorry, I did wrong. Your equity is 27 lakhs 60. So that will give you this as 81 lakh 60. So can I have weights 0.66 and point? This will be what? 0.34. And do you have cost of debt? What is the cost of debt which they have told you? The debt is how much percentage rate? How much percentage debt rate is given to you? 12%. I cannot write down 12% because now the tax rate is given to you. So I have to write down after tax cost of capital. So it is going to be 12% into what? 1 minus, what's the tax rate? 0.4. So this is going to be what? 7.2. Do you have any KE available? Yes, 25.04. We will get your KO. Everyone got it? So your KO is now going to be what? Give me the answer. 0.66 into 7.2 and 0.34 into 25.04. So this should be 13.27%. Just check. This should be your 13.27%. 13.23%. Have you understood but how do we have to solve this particular part? Okay. So you guys can just check. What we have done is now with A, the market value is coming as how much? 81 lakh 60. What is the KO? 13.27. And what's your KE? 25.04%. This is the final answer. So this is for MM with tax and this is for MM without tax. And you can just check in MM without tax, the market value of the company and KO is going to always remain the same. But when it comes MM with tax, your market value of the company is not going to be the same. It's going to be different. Are you all convinced? Okay. But this is just B limited. This is A limited. This is unlevered. This is levered. Fine. I'll give you this notes. After that, you all can just copy this down, practice it again, because if I give you time to copy this, it will again take 10-15 minutes. Okay. But it's manageable. You'll be able to do it. Come on, yaar. Okay. Question number 9. Shall we? Okay. Leo has net operating income of 21 lakh 60. And the total capitalization rate of is nothing but what? 120 lakhs. What is net operating income, by the way? EBIT. The company is evaluating the options to introduce debt financing in the capital structure and the following data is given to you. Just check. There is debt, 0. Interest, of course, not available. And this is at the rate of K is 12%. Then there is debt of 10 lakhs. Then there is debt of 20, 30, 40, 50, 60, 70, 80. We have the KD available. We have the KE available. You are required to compute the equity capitalization rate if MM approach is followed. So can I say if there is MM approach, one thing is for sure that your KO is going to be constant irrespective of the debt which you are taking in the capital structure. So is your KO going to be constant? Come on, yes or no? Yes, sir. Assume that the profit, there is 0 tax and the calculations are to be based on book value. So you know what is the first thing you have to do is, first thing is we are required to calculate the KO. Because this KO is going to be constant for all the types of plans. So what's the first thing which you are required to do, beta? Calculate KO. How will you calculate KO, everyone? How do you calculate KO, guys? Can I say KO is nothing but EBIT upon what? Market value of firm into 100. Come on, yaar. This is how you calculate KO. Come on, yes or no? Yes, sir. Now, what is the EBIT? Just check. What's the EBIT? 21 lakh 60. Come on. What's the market value of the firm? Can I say that is 120 lakhs? Can you give me KO? How much? 18%. Now, will this change with the change in the capital structure? No. Now, let's talk about the first part. So, they have told you that you are required to compute what? Equity capitalization rate. Okay. So, this equity capitalization rate which is given to you, that is not going to be applicable to you. We are required to calculate the equity capitalization rate. So, in the first case now, there is no debt in the capital structure. So, can I say in plan 1, so your K is going to be 18% only, yaar. Hello? Just check. In plan 1, it's going to be 18% only. But now let's talk about plan 2. Can I say there is debt and equity both? Give me what is the value of debt. What is the value of debt? 10 lakhs. What is the total capitalization? 1 crore 20 lakhs. What will be the value of equity? 1 crore 10 lakhs. Can you give me the weights? This will become 10 lakhs divided by 120. 0.08333 minus 1. So this will be 0.91667, right? What is your cost? So what's your cost of debt? 7. Solo yaar. Okay. And what's your KO? KO is fixed at 18. KO is fixed at 18. So can I say this is 0.808333 into 7? Will this give you 0.58333? Come on, yaar. Okay. So now in this particular case, if I subtract this by 18, this will be 17.4167. I have to calculate key. Let this be x. So can I put it like this? Come on, yaar. Okay. So can I put it like this? This is nothing but I can take 17.4167 and if I divide that by 0.91667. So you should be getting exactly 19%. So is this your key, which is 19%? Have you all understood this? Okay. So basically, if you do it by this particular approach, I know that my KO is 18. So then this is 0.91667. So you can also do it like this, 0.91667x, as we have done in the previous question. So then you can take 0.5833 plus 0.91667x is equal to 18. You find your x, you'll be getting this answer. Same thing only. Okay. But this is going to be lengthy. Why? Because then you have to prepare the table for how many number of times? 10 times. Because there are 10 capital structures which are given to you. So then you can follow this particular approach also, which is KE is equal to KO plus KO minus KD. Matlab from your KO, you are just subtracting your weighted average cost of debt. So that much if you subtract it, you'll be getting the final answer. So you can do it in this way also. Okay. This is your question number 9. Now let's do your question number 10. Aksar has sales of 68 lakhs, variable cost is 60%, fixed cost is 16 lakh 32,000. And the capital of the company comprises of 12% long-term loans, 1 lakh preference shares carrying dividend rate of 10% and 1 lakh 50,000 equity shares. The tax rate applicable to the company is 30%. At current sales level, determine interest, EPS and the amount of debt for the firm if 25% decline of sales will wipe out the EPS. We have already done this kind of a question. Do you know we can use your combined leverage, percentage change in EPS, percentage change in sales. We know that if it is wiped off, then what will be your CL? Then you have to prepare the income statement accordingly. Okay. So I'm not preparing this. It is very much manageable. We have done this kind of a question leverage. So you all can just refer to that. Okay. Question number 11. Okay. You all want me to solve that question? 10th. You'll be able to manage it. It is very much what we have done that earlier. The same thing is repeated. Question number 11. Now see what is given to you. The financial advisor of Sun is confronted with the following two alternative financing plans for raising 10 lakhs that is needed for plant expansion and modernization. Okay, everyone, how much amount do we need, guys? 10 lakhs. Okay. So what do we always usually do? We prepare working note number 1 and what is that? Summary. Okay. How many alternatives do you have? 2 alternatives. Okay. And in the first case, what have they told? That issue 80% of the funds with 14% debentures. How much is the funds required? 10 lakhs. Okay. And are we taking debt? Yes. Are we taking equity? Also yes. Okay. But please tell me what is going to be your debt. See, you require 10 lakhs. So can I say this will be 8 lakhs? But they have told you with 14% debt, which is at par and redeemed at a premium after 10 years, and balances by issue of equity shares. So balance is by issue of equity shares. But to calculate the number of equity shares, don't you think we need old shares and new shares? In this question, this new shares is to be issued at a premium of what? 33.33%. So we will check what is the face value, and to that we will add 1/3 of it. So we'll be getting the issue price. Alternative 2 is raise 10% funds required by issuing 8% irredeemable debentures. So can I say how are we raising this? 10% of the funds. So that is 1 lakh is by the way of debt. Solo yaar. So then this has to be what? 9 lakhs. And the remaining is at the current market price of 125. So here to at least I can get number of equity shares. Can you please tell me 9 lakh divided by 125? What's the number of equity shares? 9 lakh divided by 125. Tell me. 7,200 shares. Okay. And the current firm's EPS is 21. That's okay. The modernization and the expansion program is expected to increase the EBIT by rupees 2 lakhs. So whatever is your existing EBIT, to that if I add 2 lakh rupees, will I get the EBIT after expansion? Come on, yes or no? Yes, sir. And they have told you that this is the balance sheet in which current liabilities, term loans, reserves, and there is equity shares. And what's the face value? 100. Can you please tell me if the face value is 100 and the premium is what? 33.33. So 1/3. So in this particular case, what's going to be the issue price for the new shares? 133.33. And how much amount are we raising? 2 lakhs. So can you please take 2 lakhs and divide that by 133.33? Huh? 1,500 shares. Do you already have old shares? Do you have already old shares? This is 20 lakhs and we have to divide that by 100 each. Can you please give me old shares? How much? 20,000. Which is going to be forming part under both the case. Okay. So what is going to be the number of equity shares? 21,500, 27,200. Right? Just check. So your number of equity shares is 21,500 and 27,200, which we have already got it. Everyone's okay with this? Okay. Chalo. Next, continuing further. However, the finance advisor is concerned about the effect of issue of debt which can be having in the firm. The average debt ratio is nothing but what? 35%. If he believes this ratio is exceeding, the P ratio of the company will be what? 7. Okay, because of the potential risk. If the firm increases the equity capital by more than 10%, he expects the P ratio will increase to 8.5 irrespective of the debt ratio. Now please tell me, in which of the case are we increasing your equity by more than 10%? So what is your equity here? This is 2 lakhs. And in this particular case, what was your old? 20 lakhs. I hope you guys are trying to understand. In this particular case, your equity is not increasing by more than 10%. I hope you are understanding. Is your equity increasing by more than 10%? It's not increasing. It is not increasing. It's exactly 10%. So in this particular case, your P ratio, if I want to check P ratio, your P ratio cannot be 8.5. Your P ratio cannot be 8.5. But in the second case, what is the value of the equity? 9 lakhs. And is it increasing by 20 lakhs? Come on, yes or no? Yes, sir. So just check now. This is what? 20 plus 10 what? 30 lakhs. Even if I take reserves and surplus also. So this is 30 lakhs. Okay. Whereas they have just told equity share capital only. So equity capital by more than 10%. So what was my old equity capital? 20 lakhs. What is the fresh issue? 9 lakhs. Come on, yaar. So is it increasing by more than 10%? And if it is increasing by more than 10%, then what should be your PE ratio? 8.5. So in plan 2, what should be your P ratio? 8.5. Everyone got it? One thing I'm just showing you. So P ratio is 8.5. For plan 1, now let us check what is going to be the debt ratio. How will you calculate your debt ratio, guys? So for your debt ratio, can you all please tell me, you had old debt, how much amount? Just check. Old debt, how much amount you had? Old debt. Old debt was 15 lakhs. How much is the new debt? 8 lakhs. So just check 23 lakhs. What is the total capital employed? The total capital employed is 55 lakhs. How did you get 55 lakhs? Because just check, you already have your, how much amount do you have, beta? 10 lakhs, right? And what is your existing capital employed? Your existing capital employed is 35 lakhs, which is debt plus equity. Are debt plus equity is nothing but your existing capital employed, na? What is existing capital employed? 20 plus 10, 30. 30 plus 15, what? 45 lakhs. So this was your existing capital employed. And how much additional funds are you raising? 10 lakhs. So what's going to be your total capital employed after expansion? 55 lakhs. So this is 23 upon 55. This is 41.82. Is it exceeding 35%? Yes. So what should be your P ratio? 7. So just check. It should be 7. Understood this? But for plan 2, then we are not concerned with debt ratio. We are concerned with your second condition, because its equity is what? Greater than 10%. So can I put it like this? It has to be what? 8.5. Got it, everyone? Okay. Now continuing further. Applicable tax rate is 25% and the target payout ratio is 60% for the next year, and the growth rate is 10%. Now we are required to calculate what is the EPS and MPS of the company. So first let us talk about EPS. For that we need the starting point, which is EBIT. Just check, do we have any EBIT? So if you guys can just check, they have told you that in this particular question, current EPS is what? 21. Can you please give me number of equity shares? Can you give me number of equity shares? 20,000, 20 lakh divided by 100. So it's 20,000. Can you please give me what is the net profits for equity shareholders? Because I have EPS, if I multiply that by number of equity shares, can I get the net profit for equity shareholders? Solu, yes or no? Yes, sir. What's your EPS? 21. What's the number of equity shares? 20,000. What's your net profit for equity shareholders? 4,20,000. So now, if I take EBIT, what do I have to subtract? Interest. What do I get? EBT. If I subtract tax, what do I get? NPAT. Can I say this NPAT is also called as net profit for equity shareholders? So what is my net profit for equity shareholders? 4,20,000. If I go reverse, can I get my EBIT? Can I get my EBIT? Okay, give me my EBIT now. What is going to be my EBIT? Everyone, please tell me that for your EBIT, what's the tax rate which they have given to you? 25%. So this is 75. Give me EBT. 5,60,000. And do you have any old interest? Do you have any old interest? Yes. That is 10% of 15 lakhs. That is 1,50,000. So what's your old EBIT? 7,10,000. So what's your old EBIT, guys? 7,10,000. What is your additional EBIT which you are earning? 2 lakhs. So can you all please give me new EBIT? 9,10,000. Don't you think this should be your starting point? 9,10,000. Oof. Have you understood this? So we have to start with the starting point, which is nothing but 9,10,000. So now from this, I'm going to subtract interest. Then I'll be getting EBT, subtract tax, NPAT, net profit for equity shareholders, EPS into P ratio, MPS. And then we are also required to calculate in the second part of the question, what is your FL? So EBIT upon EBT, that will give you your FL. So then this will give you your financial leverage. And in the third part, we are required to calculate WSCC and marginal cost using book value weights. So now we are required to calculate your WSCC. Now, how will you calculate your WSCC? So the first part is, do we have your first, see, because there are two plans which is given to you, right? There are two plans. So we have to calculate WSCC for both the plans under both the methods. We have to calculate WSCC for both the plans under both the methods. The first part is calculation of total and second is using marginal value weights. Okay, so first let us calculate regarding the total part, because total is very easy for you to understand. Under alternative 1, can you please tell me what is going to be your equity? Under option 1, what is going to be your equity? Okay, so now I'll explain you this. See, equity share capital. Just check in your summary, are we taking equity? Come on, are we taking equity? What is your existing equity? What is your fresh equity? 2 lakhs. And what was your old equity? Just check this out here, 20 lakhs. So can you please give me what is going to be your equity share capital? 22 lakhs. Will there be any reserves and surplus? Yes, there is reserves and surplus. Just check how much is that? 10 lakhs. Will there be any existing debt? Yes. How much is that? 10% debt. Can you please give me 10% debt? How much is the amount which they have told you in the question? 10% debt, 15 lakhs. Acha, by the way, are we also issuing some debt? Come on, yaar. How much is that? 8 lakhs. So this debt is 8 lakhs. And what is the rate of interest for a new debt? For your new debt, your rate of interest is, they have told you in the question, how much is it? 14%? Come on, yaar. 14%. This is option 1. How we are raising the funds. What's the total amount? It has to be 55 lakhs. Is it 55 lakhs? Just check. So it has to be 55 lakhs. Now can I calculate my weights? So once I get the weights, I need to multiply that with what? Cost of capital. To get what? Weighted average cost of capital. So now we have to calculate cost of equity. Cost of equity, cost of reserve and surplus, same. We'll be calculating this cost of debt and this cost of debt. So now which knowledge you should apply for the purpose of calculation of cost? Cost of capital knowledge. So just check. They have told you that regarding your equity, what they have told you. For equity, I think the information given to you is here. What is the target payout ratio? 60%. So guys, the target payout ratio is 60%. So whatever is your EPS, you have to multiply that by the payout ratio to get what is the dividend per share. Okay. Now see, let us just check how do we calculate your KE. Okay, just check. What is the EPS? 22.6. How did I get the EPS? From here. Can you just check? EPS under plan 1 is 22.6. So from 22.6, I need to multiply that by the payout ratio. So I'll be getting dividend. The growth rate is 10% and the market price is 158.2. So based on this, if I apply this, can I say I can get my KE? Come on, yes or no? Yes, sir. So that is 9.43%. So this will be your 9.43%. And as I told you, KE, KR both are same. Now we have to calculate 10% cost of long-term loan and 14% cost. How will you calculate 10% cost? So this is your existing part which is given to you in the question, 10%. This is irredeemable in nature. How do you calculate your post-tax cost? We simply take interest and multiply that by 1 minus tax. So you'll be getting your post-tax cost. Your post-tax cost is going to be what? 7.5. And for convertible debentures, are we going to use redeemable debentures? Bigger formula, come on, yes or no? Yes, sir. We have RV, we have NP, we have everything given to you. So based on that, this will now be 10.95%. Then you have to substitute 10.95% here. And eventually, you will be getting the final answer, which is your WACC, 9.12%. For the second option, same concepts will apply. So there is equity, there is reserves and surplus, okay. There is 10% loan, and then we are raising 8% irredeemable debentures. So for its cost calculation, I will use this data, which is given to you in the second alternative. That what is going to be your 8% irredeemable debentures. So what is going to be the final answer? It is 8% into 1 minus tax rate, and then we are going to divide that by net proceeds, which is 125. No, the net proceeds were 100 only, sorry. So then in this particular case, you simply have to take 8 into 0.75. That is going to give you 6%. This is 7.5. And then we have to calculate your KE. So we calculate the KE by using the same concept which we have done here. What is your EPS, payout ratio, growth rate, calculate KE, and this is your cost of debt, etc. So this is how you calculate it. So that will be 7.66%. Now this is for the entire cost of 55 lakhs. But they have also told you are required to calculate for your marginal. So marginal was not 55 lakhs. Marginal was only 10 lakhs. So here we have to only calculate for 10 lakh rupees. So for that 10 lakh, we have equity, reserves, okay, and then we have 14%. This, there is no need to write down equity and reserves separately. We can simply write down market value of equity, only 2 lakh rupees. But they have told you that because it's book value weights, that's why they have specified equity and reserves. Because whatever is the premium part, that premium always goes in your reserves and surplus. But there is no need to calculate your reserves, but you can directly do it also, equity. And then if you do it in this particular way, you'll be getting 10.65 and 7.58. But remember that in your additional, you just have to take what? Only 10 lakh rupees. That's it. Very, very, very lengthy question. Okay, but it's good if you can practice this, okay, based on whatever understanding we have. So based on that, you'll be able to solve it. Okay. So with this, my dear students, now one more chapter is completed in your revision, and which is that beta, your capital structure. Okay.